What is Bitcoin? Bitcoin is a term we hear all the more often nowadays. It permeates in society as an enigma of extreme volatility that geeks and tech wizards keep themselves busy with, while criminals tap into the anonymity aspect of it to facilitate illicit activities. Others consider it revolutionary and something that will disrupt multiple facets of the material world. This divergence in views has sparked a good amount of controversy around the cryptocurrency. What needs to be understood is the difference between news and development. Development is something that needs to be covered every day. It is a progressive quality that takes time to move through all its stages and to get where it is ultimately heading. Keep in mind, its destination is never a guarantee. For news, development is generally too cumbersome. It lacks the excitement and the liveliness something like intraday volatility offers. Therefore, it tends to be neglected by news broadcasters. Although not something that glitters of gold, Bitcoin is the type of technology that is certainly worth taking a deeper look at. Remember, it is only by understanding something that one can judge it for what it truly is. The blockchain. The name blockchain is self-explanatory. It is a chain of ledgers, known as blocks, in cyberspace with Bitcoin as the medium of exchange. Blocks are added to the chain by agents known as miners. Miners pick up transactions being broadcasted by end users from the memory pools of full nodes, user computers on the Bitcoin network, by which the transactions have been verified. Miners and nodes, sometimes used interchangeably, are independent operators incentivized by economic rewards from the network to keep the network running. Since this network can be joined and left freely, and nodes are single, separate entities, the network is considered decentralized, as opposed to being under the control of any one government or institution, which is considered centralized. Miners bundle transactions pulled from memory pools into blocks and attempt complex cryptographic puzzles to validate the block. It is validated once a hash commensurate with the level of difficulty set out by the network has been generated. The first block to be validated is added to the blockchain, and the miner gets rewarded with a certain amount of Bitcoin, hence the name miner. This Bitcoin is added to the validated block, and so new Bitcoin has been brought into the Bitcoin ecosystem. There are several Bitcoin blockchains in existence at any time. However, it is the longest blockchain that holds precedence. This is the consensus view, and therefore, the blockchain is monitored by all users. The blockchain encompasses all transactions ever made in Bitcoin, from origination to present. If the transaction has not been confirmed and validated, it has yet to happen. Consequently, the history of transactions is the currency. The blockchain is Bitcoin. At the time this book was written, 714,419 blocks had already been mined by Bitcoin Worldwide 2022. Bitcoin wallets. Bitcoin needs a means of flowing between parties to achieve its desired effect as a medium of exchange. The tool that enables the initiation of a Bitcoin transaction is called a wallet. It also enables the user to monitor their Bitcoin balance. The name is a slight misnomer, as it is not something Bitcoin gets stored on per se, but rather an intermediary between the user and the blockchain where Bitcoin resides. Remember, Bitcoin exists only as a sequence of transactions known as the blockchain. Therefore, it is not something that can be held, only used. It is the private key that gets stored in a wallet, which, in essence, is as good as the Bitcoin itself. When a wallet is created by a user, two keys are provided, a public and a private key. Those keys are what the user needs to move their Bitcoin for whatever purpose, transactions, transfers, remittances, etc., all of which will be referred to as transactions going forward. The public key is available for all to see and is an address in cyberspace to which Bitcoin can be sent to. The private key is only visible to the user and is used to sign a transaction with a digital signature which cannot be forged without access to the private key. The digital signature is what authenticates the user, as it proves to the nodes that they are authorized to spend those funds. The public key is used to establish the legitimacy of the digital signature. The user's digital signature is considered their digital identity, which conceals their true identity. This feature is one component to the cryptographic nature of cryptocurrencies. The signature cannot simply be copied, as it is a function of the message and the private key. Messages are dynamic since they include a time stamp. Attempting to forge a signature on another message will result in different signature and a rejection in the authentication stage. There are various wallets a person can make use of, each with its own unique set of features and level of security. Their main differentiation is on the basis of what is known as hot and cold wallets, typically characterized by convenience versus security. Cold wallets are considered significantly more secure than hot wallets, as they are disconnected from the internet and, therefore, out of reach of hackers. Their biggest threat is the user itself. They are at the complete mercy of the user's prudence, as the wallet is tangible and subject to theft or loss. Examples of cold wallets are paper wallets and hardware wallets, which encompass a variety of storage devices. Hot wallets are connected to the internet, which augment their ease of use in transacting with Bitcoin. Some hot wallets are provided by third parties. These are known as non-custodial wallets. The third-party provider holds the private key and signs transactions on behalf of the user. Hence, the non-custodial aspect. They are easy to use and support a variety of transactions, but are vulnerable to hackers and bankruptcy. Custodial wallets remove bankruptcy risk, but still face the risk of being hacked. Examples of custodial hot wallets are mobile wallets and desktop wallets. Rule of thumb in the cryptocurrency space is if you possess a large amount of crypto, you should store it in cold wallets. One can still tap into the ease of use aspect of hot wallets by moving a prudent amount of funds between a cold and a hot wallet. Chapter 1: History of Bitcoin. The concept of digital cash has been experimented with since the 1970s. It seemed to be a nexus of impossible paradoxes that would turn any mind brave enough to face it into a state of terminal nausea. What was needed for digital cash to work as a currency was a continuous current that ran between the points of fidelity, scarcity, idiosyncrasy, pragmatism, unforgeability, anonymity, and information. The impetus set out that ultimately led to Bitcoin's creation was a cryptographic electronic money known as eCash, created by sapient crypto guru David Chaum, the father of online anonymity. eCash lasted no longer than a flame needed to set off a fuse synthesized from the cryptocurrencies that succeeded it. The company that had created the money went belly up 8 years later, and eCash along with it. But the fuse kept burning and soon triggered a bomb called Bitcoin. The explosion hardly shook the world, but a few speculators and believers took notice and have since been lifted into financial nirvana. Bitcoin's ultimate differentiator from its predecessors was the concept of decentralized finance, DeFi, a type of upheaval that ushered in a new era of finance and has Bitcoin acting as the bellwether and trailblazer among cryptocurrencies. The genesis of Bitcoin. Satoshi Nakamoto, a pseudonym that has echoed through the sphere, a sphere that, like the universe, has been expanding, of Bitcoin fanatics and haters since its introduction in 2008 alongside the white paper that had been written by the anonymous entity. Satoshi Nakamoto had set out to solve two distinct problems that came with an electronic payment system: its centrality and double spending. Double spending becomes a problem when the centrality aspect, the essence of a financial institution, is absent. In other words, the one problem is only introduced by the absence of the other. The solution was the blockchain, with the mechanics necessary to eliminate the need for a third party to provide and maintain the quality of trust among participants. Satoshi was able to obsolete these third parties by means of cryptographic proof, generated once the necessary amount of work is put in by a node to meet the required network hash. Once verified by the other nodes, the block is eligible to be added. Nodes are kept honest with the right economic incentives, provided by the network with the common understanding that the longest chain holds precedence, which over time eradicates conflicting transactions. This is a system that essentially replaces trust with confidence. Confidence is maintained with the presumption of rational actors that would only be shooting themselves in the feet if they were to jeopardize the system through deceitful practices. To reiterate what has already been said, Bitcoin is the blockchain. As a result, Bitcoin's purpose is the blockchain's solution to decentralize the payment network while simultaneously preventing double spending. Many other enticing propositions have stemmed from this solution that are in line with what makes for a true currency, propositions such as its scarcity as a digital product, its ability to act as a store of value, the social and humanitarian value it has shown to have, the ability to circumvent political barriers, and the quality of being uncompromisable and incorruptible. A finite resource. There are many facets of Bitcoin that have made it revolutionary. What has brought about its store value characteristic is the fact that Bitcoin is of limited supply. It is the first digital product considered to be so. Embedded in its code is a hard cap of 21 million Bitcoin, a fixed amount set to be reached in 2140 based on halving and the average rate at which Bitcoin is being mined. The halving concept results in the amount of Bitcoin mined per block being halved every 4 years. Currently, the amount of Bitcoin issued per block is 6.25 Bitcoin. The next halving event is set to occur in 2024. Once the supply ceiling has been reached, miners will be compensated purely in transaction fees. Currently, transaction fees make up a small portion of a miner's total revenue. However, as the Bitcoin ecosystem grows, transaction fees are expected to rise. Over the long term, there is no guarantee that the rise in transaction fees will be commensurate with the fall in Bitcoin mined per block created. It entirely depends on how the ecosystem grows over time. There are other developments which take place around each halving event that further aim to counter the disincentivizing effect halving has on miners. The drop in Bitcoin minted per block with each halving event increases its scarcity, reduces its synthetic price inflation, and shoots up its demand in response to the first two developments. These developments result in Bitcoin rallying, which should be adequate alleviation to the hit miners take from a halving event. In case the price rises in Bitcoin, is of inadequate alleviation to miners. The system will respond with an ease of mining to keep miners incentivized. For Satoshi, the idea behind the 21 million hard cap was to make Bitcoin similar to gold and immunize it from the erosion of value fiat currencies suffered today. Since the fall of the gold standard, governments have engaged in boundless and sometimes reckless money printing. Every time new money is added to the economy, it loses some of its value, the result of a simple economic supply-demand relationship. This, in turn, causes inflation and the erosion of purchasing power. Because of its 21 million hard cap and its set-in-stone halving system, Bitcoin is insulated from paper money inflation and, therefore, considered a store of value just like gold. Its own synthetic price inflation is affected only by minted Bitcoin, which, as mentioned before, is set to come to an end in 2140. Some criticisms and concerns have revolved around the fact that Bitcoin is of limited supply and how whales in the Bitcoin market can send its price plummeting with just one large offloading of the cryptocurrency. When Bitcoin started out, each block created was awarded 50 Bitcoin. The demand for Bitcoin in relation to the pace at which it was entering the market was starkly different from what it is at present. It was easy and cheap to accumulate large amounts of Bitcoin. Those that held on to it through its early years to present have become what is known as Bitcoin whales. Other large holders of capital, such as institution and ultra-high net worth individuals, have also gained whale status in recent years. This cohort of Bitcoin owners holds roughly 45.6% of the world's Bitcoin. Of the current active addresses, 0.24% belong to Bitcoin whales. This whale phenomenon can partly be attributed to its rarity, which in turn supports its store of value concept. The store of value concept then starts to contradict Bitcoin's feasibility as a currency, as it might start to impede the fluidity of the currency when people start to consider it more valuable to hold on to the cryptocurrency rather than spending it. Moreover, if demand continues to increase, this could lead to supply shocks and stupidly high subsequent prices. It also makes Bitcoin vulnerable to instances in which these whales decide to offload some of their Bitcoin holdings. Chapter 2: Price Action of Bitcoin. Bitcoin has become quite known for its intraday volatility. Its price chart on some days looks like the raging scribble of a Philistine attempting to write a poem. Devastating whipsaws up to 10% wide. Those that have the stomach and fortitude for it find this quality particularly attractive and look to profit from it. Others consider it the bane of Bitcoin's existence and wouldn't touch it with the riskiest account in their mental accounting hierarchy. Bitcoin is by no means an adult in its development as an asset. There is still much to be understood and discovered about the cryptocurrency, while institutions and investors try to figure out how they are going to react to Bitcoin's existence. This discovery phase is what largely contributes to its volatility and is why a simple tweet from Elon Musk can have Bitcoin going bonkers. However, the more established Bitcoin becomes and the more is understood about the cryptocurrency, the more stable its price is likely to become. Price discovery in the Wild West. Price discovery is at its most active in the early years of an asset's life. All assets trading in the market go through a daily process of price discovery as they get bought and sold between market participants. Markets are generally considered to be efficient. Therefore, the price you pay for an asset is considered to be the fair value of an asset. In reality, it is the market value, the price observable in the market, an investor pays for the asset, which is not always equal to the fair value of the asset. This concept is beyond the scope of the book and therefore will not be discussed in any further detail. The fair value is the market's best estimation of the intrinsic value of that asset. The intrinsic value is unobservable and hinges on a myriad of futuristic factors. The younger, less established the asset is, the harder it is to estimate its intrinsic value, which leads to wild fluctuations in its fair value. Compare the life cycle of an asset to a human's life cycle. While still in their infancy, humans have their whole lives ahead of them. Each life is unique and uncertain. The trajectory of a life is conditional on many factors that have yet to take place. As a person ages and develops, that trajectory becomes more clear and predictable. The movements in Bitcoin's price is a constant attempt at anticipating the development of its trajectory. Any news that hints at the development of any one factor, considered to be important to Bitcoin's trajectory, leads to a reaction in price when paired with a lack of understanding of the cryptocurrency. This phenomenon leads the Philistine to scribble. The volatility of Bitcoin also stems from the valuation challenge it poses. Investors generally value assets based on the future expected cash flows of that asset. The cash flows are discounted to come up with an intrinsic value for the asset. Since no income flows from Bitcoin, investors have to resort to less established means of valuing the cryptocurrency. The variance in valuation methods used, paired with the variance on what drivers are considered significant in the determination of its price, makes for extreme volatility as new information on Bitcoin is disseminated. One must also overlook the speculative status of Bitcoin in the context of short selling. Short sellers love speculative assets since speculation at times has prices getting wildly out of hand on the long end. This will prompt them to build large short positions, which pushes the price down and thereby adding to the volatility. Bitcoin whales, paired with a lack of regulation in the crypto market, have at times led to massive price swings, either in an attempt to front-run the whales or the action of the whales themselves. The belief is most of these whales are on familiar terms with one another from Bitcoin's early days, back when they were considered delusional aficionados rather than whales. They stuck together through Bitcoin's condemnation in those days and colluded on their Bitcoin activities today. Since regulation is basically non-existent in the crypto market, coordinating on Bitcoin activities can be done with ease. This is mainly due to the cryptocurrency's nature, making it basically impossible to regulate, as well as regulators having been slow to catch up to the crypto evolution. There is no Uncle Sam or Uncle Sam equivalent to the curb these types of manipulative practices as it is with human nature. When something can be done, it is generally done. Traders that constantly attempt to front-run the whales have several monitors in place. Anomalous activities picked up by these monitors are considered signals that the whales are about to make their move. Traders will place their trades in anticipation of the move and, in doing so, bring volatility into the market. Sometimes these signals turn out to be false, something only realized after the fact. By that time, the trade has already been placed, and as traders backpedal to reverse what is still salvageable, Bitcoin rides the seesaw. There is also the retail institutional investor dichotomy that offers explanation for the volatility of Bitcoin. Up until recently, Bitcoin investor base had been dominated by retail investors. Retail investors are known to be less sophisticated than institutional investors. They are subject to investor biases that result in the distortion of asset prices, and, at times, they act emotionally and impulsively, which shows up as volatility. Conventional wisdom attributes efficient price discovery to institutional investors who value in an orderly manner. They are more meticulous and rational in their decision-making and are commonly less subject to investor biases. Institutional adoption of Bitcoin has been significantly slower than the retail side due to certain regulatory and in-house regulations aimed at protecting institutional stakeholders from speculative behavior. However, over recent years, as Bitcoin has become more established and more than just a fad, institutional adoption has proliferated. Despite this proliferation, the capital that has flowed into Bitcoin from the institutional side has still been quite benign, and a significant drop in Bitcoin's volatility is yet to be seen. Bitcoin market cycles. Every market moves in cycles, typically characterized by a boom and bust. The boom is when activity picks up from a previous market cycle trough and shoots upward before eventually overheating, causing the bust and subsequent drop to the next trough. Cycles repeat over varying time periods, but they always occur and are one of the chief factors in an investor's decision-making process. Bitcoin is no exception to this phenomenon. It has cycles of its own that are broken up into phases, just like any other market cycle. These phases are the accumulation phase, the run-up phase, the distribution phase, and the subsequent drop. The accumulation phase can be seen as a transition phase from a bear market to a bull market and starts at the trough of the previous market cycle. The run-up phase is where a bull market is confirmed and most of the smart money starts climbing in. In the distribution phase, all the laggards scuffle to get on the bandwagon, resulting in one last price surge and an oversaturated market. In this phase, the asset's value becomes disconnected from its fundamentals and sentiment turns mixed. Conflicting sentiment has price oscillating in a band until overall sentiment becomes bearish and the market tanks. Bitcoin's market cycle lasts approximately 4 years. There have been 5 Bitcoin market cycles since its inception. The first cycle was triggered when Bitcoin was mentioned on a newsreader early July of 2010. In 6 months, its price shot up to its first cycle peak of $1.06, roughly a 900% rise, and bottomed out at 67 cents 2 months later. The next cycle was driven by pure criminal mania when an article described Bitcoin's use case for purchasing illegal narcotics on a criminal website under the misconception of untraceability. It peaked at $29.58, roughly a 3,000% rise on June 9th, 2011, and bottomed out 5 months later at $2.14. Since then, Bitcoin's market cycles have centered around its halving events, which has become the bedrock for its 4-year approximation. Its 2013 bull run resulted in a price increase of approximately 6,777%, and its 2017 bull run resulted in a price increase of approximately 1,865%. Its most recent bull run kicked off shortly after the outbreak of COVID and resulted in a price increase of approximately 1,147%. Up until recently, each major cycle bottom has ended above the previous market cycle top, which has supported an overall uptrend in the cryptocurrency. The first cycle peak topped out at $1.67. The second cycle trough bottomed out at $2.14. The second cycle peak topped out at $29.58. The third cycle trough bottomed out at $172.15. The third cycle peak topped out at $1,172.45. The fourth cycle trough bottomed out at $3,164. However, in June 2022, this phenomenon was violated for the first time. The price plunged from the November 2021 cycle top, $68,630, to $17,961 to breach the December 2017 cycle top, $19,665. Some consider this to have been a violation of the theory that previous market cycle tops will not be reached by succeeding cycle bottoms. Technically speaking, it was. However, it is hardly the disaster these apocalyptics made it out to be. The next day, Bitcoin bounced up to above the December 2017 high and has stayed there until the time of writing this book. Occasionally, it has tested the previous cycle top, but respected it each time as a powerful level of support with a subsequent bounce to the upside. A new era for Bitcoin. Every cycle has its own set of catalysts. Bitcoin's greatest catalyst is believed to be the halving event. The reasoning is as follows. When a halving event takes place, the same amount of demand is then being met with a lower amount of supply, resulting in a price increase. The increase in price will attract attention, heightening demand and supporting a further increase in price. It then becomes a matter of momentum, as is the case with all trends, until eventually running out of steam and experiencing a reversal. There have been 3 halving events up until 2022 in Bitcoin's lifetime. The first occurred in 2012, the second in 2016, and the third in 2020. Each time in the span of about a year after the halving event, the price increased significantly. Between the last quarter of 2021 and the third quarter of 2022, interesting developments had started to take place in the Bitcoin market. Well-known models and hypotheses have been failing, and as mentioned before, Bitcoin had, for the first time, reached its previous cycle bottom. The stock-to-flow model, created by Plan B, which bases Bitcoin's future price trajectory on 2 sole variables, stock and flow, had lost credibility in late 2021 when Bitcoin started with a significant downward divergence from the trajectory set out by the model. Benjamin Cohen's Bitcoin lengthening cycle hypothesis had recently been discarded in May 2022, when the Bitcoin bear market became too overwhelming to argue that the cycle top was yet to be reached. The lengthening cycle hypothesis assumed that each Bitcoin cycle lasts longer than the previous one. What has been potentially overlooked by many is the regime Bitcoin was born in. Call it a coincidence that the promise of immunization to failed monetary systems in the form of Bitcoin roughly coincided with the end of the greatest monetary failure to date, the 2008 to 2009 financial crisis, but I would rather not. Economies all over the world had been flogged by the systemic effects of the collapse of America's banking system. The Federal Reserve dropped interest rates to all-time lows and steadily started injecting liquidity into the system to combat the recession. Slowly, the U.S. economy and others around the world started their recovery, and, with it, the great American bull had entered the ring. For more than 10 years, most of the world had relatively well-behaved market conditions and little inflation to worry about. It seems as though some of these theories had been built without having brought into consideration that macro conditions change and markets react. It seems hardly coincidental that, at the time, inflation was no longer considered transitory in the economy that holds the largest share of the world's Bitcoin. The cryptocurrency started its devastating plunge while violating much of what had been theorized about it. In late March 2022, the Federal Reserve Bank, Fed, announced the start of a rate hiking cycle and the subsequent withdrawal of liquidity from the system. On the 1st of April, cryptocurrency traders were lining up their trades to take advantage of the next altcoin run, with Bitcoin dominance waning and stablecoins having respected their resistance line. That was the start of the most bearish period the stock market had seen since 2009. In 2 months, the S&P 500 entered a bear market, and the cryptocurrency industry had lost roughly $1.25 trillion of its market capitalization, market cap, before starting a moderate recovery. Another coincidence, or not, was the conjunction of the Bitcoin and American stock market run that took off shortly after the outbreak of the pandemic. When the pandemic was declared and fear permeated the global economy, the Fed responded with slashing interest rates and injecting an unprecedented amount of liquidity into the system. This liquidity made its rounds, with a large portion of it ending up in the stock market. Naturally, its value skyrocketed and saw enormous price moves in record time. This type of euphoria seemed to have leaked through to other markets as well, which inflated what some famed investors, Michael Burry, Jeremy Grantham, and others, started calling very fat bubbles. Meme stocks, cryptocurrencies, crypto caricatures such as Dogecoin, and companies that will probably never turn over a profit, all saw their value shoot up to a stupefying level. Bitcoin's halving event happened to take place around the time this historic run in the stock market and other markets was setting off. It also happened to come to an end around the same time the stock market made a U-turn all the way into a bear market. It's hard to attribute Bitcoin's run and subsequent fall to central bank actions alone, but with the evidence clear for all to see, it's hard not at least consider the possibility. It makes one wonder how different it would have been had the pandemic not struck and the Fed never responded with monetary easing. How would the subsequent year after the halving event have shaped Bitcoin's price? There's a saying in the market, there is no such thing as a free lunch. What is meant by this is that markets are essentially forward-looking, and because of this, all future events, or the possibility of them, have already been baked into the prices of market assets. The first two halving events are harder to dispute as having bared no relation to the subsequent bull runs of Bitcoin. But for the 2020 halving event, in light of everything that has happened, a different picture is painted. The halving theory is without a doubt economically sound, but with other theories and hypotheses having bit the dust as of late. The halving cycle seems, as an undisputed theory, more vulnerable than ever before. It goes to show that seeing Bitcoin as a recluse existing in a silo bopping to the drum of its own special beat might turn out to be ill-advised. It seems indeed to be vulnerable to macro developments and conditions which are notoriously unpredictable and the roof over every asset's head. Without going into the nitty-gritty of what might happen in the next decade, it will certainly be interesting to see how Bitcoin holds up in what could be the next coming of an entirely new regime and macro environment. Chapter 3. Arguments against Bitcoin. When arguing a proposition, there are always two sides to a coin. Forgive the pun, but Bitcoin is a coin no different. All topics generally seem to follow the trend of having a for and against, which brings an element of risk into it. This risky element is simply part of the nature of our world. If there was no risk, all would be certain and everybody a soothsayer. With Bitcoin, a new technology still being studied every day, the bad and the good will likely continue to flow from it for some time. The hope can only be that the good will outpace the bad. No real value. Warren Buffett's biggest critique of Bitcoin as an asset is, it has no real value. In one of Berkshire Hathaway's annual shareholder meetings, Buffett, regarded as one of the best investors of all time, was asked to give his opinion on Bitcoin. He said if he was offered 1% of all farmland in the United States for $25 billion, he'd take it. If he was offered 1% of all the apartment houses in the United States for $25 billion, he'd take it. If he was offered all the Bitcoin in the world for $25, he would not take it. Note, the $25 is not meant to be succeeded by the word billion. It is not a typo. The biggest issue Buffett has with Bitcoin is that it doesn't generate a return. Farmland, for example, generates two types of return: capital appreciation and income. Income comes from the crop yields. The capital appreciation comes from the land value growing with inflation. The same goes for timberland. Both of these commodities are investment options. Apartment houses work in the same way. Just like farmland and timberland, they grow in value, usually in line with inflation, and generate periodic income in the form of rent. Company stock is a partial right to the cash flows a company will generate in the future, presuming the company doesn't turn out to be a total disaster. Bonds, a type of debt, have a periodic income stream in the form of interest. Machinery is used to manufacture products that can be sold for money. Infrastructure investments provide income in capital appreciation, also typically in line with inflation. These are all considered assets with the expectation of providing a future economic benefit. It can be hard to see Bitcoin as an asset in the traditional sense, even when thought of in the context of gold. Although gold is considered a safe haven and a store of value for investors, it is also tangible and is used as a raw material in the manufacturing of jewelry and technology, which gives it a shared characteristic with other commodities: timber, crops, industrial metals, etc. Bitcoin does not have this characteristic. It is not an input to anything. Furthermore, gold is an established store of value and safe haven. The odds of it continuing to be so are a lot higher than they are for Bitcoin. Bitcoin, like gold, is a concept of faith, highly contingent on people's belief in the cryptocurrency. Faith can be a fickle thing at times, especially when it's expected to be put in a whippersnapper like Bitcoin. Bitcoin's age is where its biggest danger resides. It is still a young prospect by the historical standard of most assets. It is not nearly as ludicrous to say that Bitcoin could see its $450 billion value get wiped out in a matter of years, compared to saying the same thing about gold. If this wipeout were to happen, it would leave many in financial ruin. This would not just be the case for Bitcoin investors, but the whole cryptocurrency industry, which currently has a market cap of approximately $1 trillion. As was said at the start of this book, Bitcoin is the current bellwether among cryptocurrencies. If it were to fall in the upcoming years, it is likely that the whole cryptocurrency industry will fall in conjunction with it. As far as no real value argument goes, Bitcoin would do best when put in the same bucket as fiat currencies, fiat. Fiat is just as much a concept of faith. The big differentiator is where the face is being directed to, the government or the opposite direction. Underworld impetus. Bitcoin has been received extremely well by the underworld. If one didn't know any better, or were into conspiracies, you'd say, that's exactly what Bitcoin was created for: criminal support. It really seems as though from each positive a negative can be extracted, and vice versa. It is Bitcoin's inclusive and government insulation aspect, which is in many ways considered a positive, that makes it so easy and effective for criminals to use. The illicit value of Bitcoin covers a wide spectrum of criminal activities such as tax evasion, illicit commerce, money laundering, terrorist financing, and cybercrime. Recall that it was Bitcoin's criminal appeal that caused only its second bull run ever. One of the qualities of Bitcoin that have caught the attention of criminals is its anonymity. The only thing a user can be identified by is his or her public key. The public key is the user's blockchain address and is considered the equivalent of a bank account number. However, where having a bank account requires information, a criminal would consider suicidal. such as your personal identity, physical address, etc. A crypto wallet requires nothing more than connection to the internet. The no-trust system embedded in the blockchain is also a thing of beauty to criminals. Just like we would never trust a criminal, neither would they trust each other. Eliminating the need for the trust gives them the security of proper execution. Another appeal to criminals is Bitcoin's intangible nature. Working with large sums of cash to the tune of billions of dollars comes with a big set of risks and difficulties. When it comes to physical money, there is the issue of storage, which oscillates between space and preservation. Bitcoin needs no space, nor does it need to be preserved. It is also not vulnerable to seizures, as it is less likely to attract the attention of the authorities. When paired with its border-agnostic quality, it becomes a very practical means of engaging in trafficking. Money laundering and smuggling requires some ingenuity from criminals from time to time. It is quite ironic to see Bitcoin follow in the footsteps of gold as a viable washing machine. Gold has become popular among money launderers not because of its visual appeal, but because of how it can be used to legitimize money. In the U.S. cocaine trade, narcos from Latin and South America have found gold as a means of dealing with the dirty paper money they accumulate in their trade. They smuggle the paper money to South Latin America, where they purchase gold from illegal gold miners. They then open a shell company through which they sell that gold to U.S. gold refineries. Bitcoin, on the other hand, requires significantly less ingenuity to use as a money laundering tool. Because of its unregulated nature, it has become conspicuous to criminals as a money laundering device. Online gambling websites that accept deposits in Bitcoin have become a favorite among money launderers cleaning their Bitcoin. They'll gamble a couple of rounds, then cash out funds that gain legal status once paid out by the website. Although operating under the feature of anonymity, transactions on the blockchain can still be tracked with ease. This is, after all, the very essence of the blockchain, an uninterrupted sequence of transactions from inception to present. It poses a problem for money launderers, as the ultimate goal is to somehow obscure the transaction history and have the Bitcoin come out clean on the other side. A service criminals use to bypass this problem is crypto tumblers. Crypto tumblers mix an obscure amount of digital assets together and distribute those assets to various addresses over time. After having been in a tumbler, it is very hard to determine the origin of the asset beyond having come from a tumbler. Another novel money laundering technique in crypto is to participate in an initial coin offering where an actor can use a digital coin, like Bitcoin, to buy a different digital coin on its first offering. The trail of the dirty coin is then basically swapped for the start of a new trail, being that of the clean coin purchased. A more traditional approach to Bitcoin money laundering is to replicate what has been done with fiat for many decades. Set up a shell company that takes payment in Bitcoin and cooks the books with false transactions. As money laundering with Bitcoin has grown in popularity, so has the erected impediment thereof. Crypto exchanges have started to implement anti-money laundering, AML policies, such as the Know Your Client protocol used by banks, which requires personal identification. Some exchanges that offer a tumbling service don't allow for the tumbled Bitcoin to leave the exchange, rendering the service useless to money launderers. There is also the prospect of further innovation via embedding smart contracts aimed at impeding money laundering practices into the blockchain as it develops. By staying out of the realm of exchanges and custodial crypto wallets, crypto users can easily evade taxes if they choose to do so. The problem mainly stems from a lack of regulation and obligation. In the US, when a cash transaction is over $10,000, the recipient must file a currency transaction report, which makes them visibly liable for taxation. No such requirement exists for a Bitcoin transaction identical in value. When Bitcoin transactions are not done on an exchange, the responsibility of reporting lies within the actor. They can simply choose not to report their earnings. If earnings are not reported, no taxes are expected. It is no different from transacting in cash without a financial intermediary involved to record the transaction. The appeal of using Bitcoin as an alternative is the size of the amount that can be transacted, The dexterity required to handle $100,000 of Bitcoin transaction is far lower than for a $100,000 cash transaction. With the many value propositions crypto offers to criminals, one would think of a criminal adoption rate so fast that the adoption curve would soon start to curl backwards. This has not been the case thus far. However, the share of illicit activities in overall cryptocurrency transaction volume have been dropping dramatically in the last 2 years, 2021 and 2022. Transaction volume for cryptocurrencies as an asset class instead of Bitcoin transaction volume alone is being used because it is considered a better metric for how criminals have been utilizing the characteristics of a blockchain to commit crime. Cryptocurrencies are still a young and innovative technology, more or less evolving in tandem, but they are not without their idiosyncrasies. Criminals are expected to move between different cryptocurrencies wherever openings are found, while prohibitors find ways of dealing with the issue as it emerges. Therefore, the overall crypto space is considered an appropriate pool for the metric to capture all illicit activities related to blockchain technology. In 2019, 3.37% of transaction volume was found to be linked to criminal activity. This is considered to have been an outlier year. In 2022, the figure dropped to 0.62%. In 2021, it dropped to 0.15%, the lowest it has been in 5 years. Keep in mind, these figures only account for the criminal activity that had been picked up on. It would be grossly misleading to take them as unbiased figures. They are most likely significantly biased to the downside. However, one can argue that prohibitors are becoming more savvy to these criminal activities and have become better at exposing them. Nevertheless, the drop in percentage volume is a significant one. Unforgiving to mistakes. There are many stories of early Bitcoin investors that could have been multimillionaires had they only not forgotten the passwords to the devices that hold their private keys. One such device is an iron key, property of Stephen Thomas, Chief Technology Officer of Ripple. The device holds 7,002 Bitcoin, worth approximately $167.4 million at the time of writing. He's reported to have had sleepless nights with his mind adrift in a vast ocean of his past in which the password resides. James Howells accidentally threw out a hard drive that held the password to a virtual wallet with a similar amount of Bitcoin, 7,500. Gabriel Abded lost 800 Bitcoin when a colleague reformatted a laptop that contained the private keys to his Bitcoin wallet. Without access to the private key, the user essentially has no Bitcoin to use. Banks and online payment companies provide users with the means of resetting their passwords if forgotten. They also help recoup losses from a hacked account. With Bitcoin, if your account gets hacked, it's c'est la vie to your private key. Bitcoin comes with the freedom, but also the responsibility of being your own bank. Most people love the freedom part. Some don't mind the responsibility part, and some are clearly not capable of the responsibility part. One can perhaps understand early Bitcoin adopters having lost the passwords to their private keys. It is likely that never in their wildest dreams did they imagine Bitcoin to surge to the price it is today. Therefore, the level of care back then cannot be expected to have been what it ought to be today. However, even with Bitcoin being valued at what it is today, people are still losing their passwords like it is 2011. Chain Analysis estimates that 20% of all Bitcoin mined are either lost or in stranded wallets. Kane Digital Island research estimates that about 4% of total Bitcoin in circulation is lost each year. Crypto Asset Recovery reports that over 1,000 people a week look to solicit their services in recovering their lost crypto funds. These cases are not linked to stolen funds, but rather a myriad of other reasons, some touching on a negligence and others on mistakes you'd only make once in a lifetime. Specialists are able to assist in this endeavor when certain prerequisites are met. Prerequisites include, but are not limited to, a possible password from a defined pool of many, a ballpark estimate nuanced because of different numbers and capitalization, and a passphrase with a combination of words on an available list of words. Once this information is provided, the application software goes on the offense with a barrage of permuted attempts in rapid succession. Success hinges on the phenomenon that people typically use the same passwords or variations of those passwords for different accounts. The success rate of these services providers have not been great. Wallet Recovery Services has reported a historical success rate of 35%. They take 20% payment of the recovered funds. If they fail to recover the funds, no payment is required. Therefore, definitely worth a try. Crypto Asset Recovery, a similar service provider, estimates that 2.5% of chain analysis estimate 20% can still be recovered. Hot wallets typically do not undergo a permanent freeze after a certain amount of passwords have been attempted incorrectly. Some crypto exchange accounts and hot wallets will freeze temporarily for security reasons, but will then be made available again once the allotted time has run out. Other more security-intensive wallets normally, hardware wallets such as Stephen Thomas IronKey, allow for 10 guesses. If all 10 guesses are amiss, the wallet seizes up and encrypts its contents forever. Apart from the bottomless chasm where all lost passwords lie, there is also a grave issue with Bitcoin's irreversibility feature. Despite this having been a positive and a necessity in Satoshi's eyes, a lot of people are finding issues with it. Although not likely to happen, people have been tugging at this pie in the sky, Bitcoin, to come down from its aloof status. In a study with 20 Malaysian Bitcoin users, most of whom had more than 2 years experience using Bitcoin, it was found that 50% of them would prefer the blockchain be identifiable and regulated, enabling transactions to be reversed. This is a small sample and is meant to be taken with a grain of salt. In his white paper, Satoshi spoke of the problem of customers defrauding merchants using the reversibility option. Conversely, without the option of reversibility, merchants can hoodwink customers far easier. It is not part of the strict definition of a currency that transactions in it be reversible. However, currency use has for long been known to come with certain features, which has become as much a part of its definition as it has a necessity. People cannot be expected to just be more careful. Some mistakes are simply unavoidable. Misdirected transactions, erroneous figures, think of fat finger trades, and fraud will continue to happen. Irreversibility deters using Bitcoin as a currency because of the frequency of these events. Dishonest traders are in the business of commerce. If the populace feels they cannot use Bitcoin as a currency in commerce, it cannot reach true currency status. Unless some changes are made, its widespread adoption is likely to hit a wall. Energy guzzler. It is no secret that the world is facing a severe climate crisis. Yet in some countries, climate denialism is still rife. The persistence of climate denialism amongst these countries is not due to what they actually believe about climate change, but rather their own lopsided incentives that do not gel with the clean energy transition. Fortunately, most countries are on the right page and have set some very ambitious goals on track to reaching net zero carbon emissions. In the private sector, environmental, social, and governance, ESG, has become all the rage. Investors want to see how a company's ESG initiatives are evolving and how they plan on achieving them. Those that are in anti-environment industries and have said the hell with ESG have been strong-armed by the government with some very costly taxes, acting as a moderate deterrent and providing governments with additional funds to hopefully counter some of the damage done. Bitcoin has become notorious for its energy intensity. It is a problem that cannot wholly be disincentivized by governments and many of the nodes, which do not operate as companies. The ESG requirement that companies are pressurized into do not apply. It is said that running the blockchain consumes the same amount of energy as Switzerland, population 8.7 million. and more than Argentina, population 45.5 million. The stark difference in size is due to Argentina's energy consumption per capita being much lower than Switzerland's. Bitcoin's insatiable taste for energy comes from the enormous amount of computing power required by miners to solve the cryptographic puzzles required to create a block, which becomes more challenging as miners join the network. There is also a lot of power wasted in this process as miners compete to solve the puzzle. Those that did not manage to solve the puzzle had essentially wasted all the power that was used in the attempt. More country comparisons show that Bitcoin is in the same area as Greece when it comes to annual carbon emissions. It is estimated that Bitcoin consumes 150 terawatt hours per year, from which 65 megatons of carbon dioxide make it into the Earth's atmosphere. These figures translate to the blockchain holding 0.55% share of the world's total annual electricity consumption and being responsible for 0.021% of the world's annual carbon emissions. A force that is working the Bitcoin energy issue in the wrong direction is the current gold rush of Bitcoin mining, with miners joining the bonanza at a staggering pace while existing miners upgrade their equipment, which generally leads to greater energy-intensive hardware to keep pace. Miners have also been bringing abandoned power plants back online. Some of these plants have been shown to be devastating for the environment, such as the Green Ridge Generation Plant in upstate New York, damaging the surrounding ecosystem in a number of ways. There's also the issue of how Bitcoin's efficiency energy consumption ratio falls miles short from Visa's. Efficiency considered here as the amount of transactions processed per second. Bitcoin's 4.6 transactions per second versus Visa's 1,700. However, the Lightning Network has largely put this debate to bed. The Lightning Network is discussed later in this book. For immediate reference, see paragraph 8 of subchapter, Finance with Wings. On an industry basis, Bitcoin compares well to the gold industry. However, the banking industry is regarded as significantly more energy efficient. These two industries are brought in for comparison since Bitcoin, as a product and a service, shares characteristics with both. The banking industry consumes around 263.72 terawatt hours per year, while the gold industry consumes around 240.61 terawatt hours per year. These are significantly higher numbers than Bitcoin's annual electricity consumption of 150 terawatt hours, but must also be taken in the context of industry size, which radically changes how the numbers are perceived. The global banking sector was estimated in the third quarter of 2021 to have a market cap of $7.5 trillion. Bitcoin market cap around the same time was $900 billion, which was about double the market cap of JP Morgan Chase, a single bank. The global gold industry was sized at $214.1 billion. Therefore, in this silo, Bitcoin is seen to be more valuable than gold for the energy it uses, yet less valuable than the banking sector. As a matter of cohesive urgency on green initiatives, the blockchain will naturally have its challenges. For a regulated, centralized industry, conventional wisdom would suggest a much more harmonious transition than an unregulated, decentralized industry. The ease of a transition relies on a lot of factors and will differ between industries, but on average, this can be expected to be the case. There's also the homogeneity effect within most industries, where solid ESG practices of a company can act as a powerful differentiator for the company. The lack of adoption can also be a disadvantage for a company if most other companies in its industry had already adopted ESG standards. Bitcoin is heterogeneous, owing its unique quality of being the only cryptocurrency that is said to be of limited supply. For this reason, it could be said that the Bitcoin blockchain would feel under less pressure to switch to a consensus mechanism that is more environmentally friendly just to stay competitive with its counterparts. Some banks in the banking sector have already started taking the initiative of becoming more energy efficient. Bank of America has begun adopting clean energy technologies and techniques. For its new branch in Florida, It is modeled by the bank that these new technologies will result in 48% energy savings. However, as far as supporting the clean energy transition goes, the results for banks are mixed. Some banks have decreased their fossil fuel financing, while others have increased their fossil fuel financing. The most severe cases are in China. There has also been the emergence of what is known as green banks, with a focus on the financing of clean energy projects, as well as green products offered to consumers by regular retail banks. Green products include green mortgages, green car loans, green cards, and more, all strengthening environmental causes. In September 2019, the World Gold Council, WGC, inaugurated the Responsible Gold Mining Principles, RGMPs, to act as an ESG guide to the gold industry. The RGMPs is a transparent and cogent set of 51 principles that aims to dovetail with the clearest definition of what constitutes ESG. Compliance is mandatory for WGC members. Gold mining companies that are not members can expect to be held to these standards by their investors. Company performance in relation to the RGMPs is disclosed publicly and verified independently. The RGMPs is a strong signal to the market from the WGC that the gold industry is set to enter a new era of mining and behavior due to the blockchain's decentralized structure and lack of regulation. Green behavior and social initiatives have mainly been left in the hands of individual miners. There are no clear standards in place on the various responsibilities of a Bitcoin miner, which is very understandable for a variety of industry reasons: detached industry, nascent industry, and unregulated industry. Bitcoin's annual energy consumption has increased by roughly a multiple of 9.5 over the last 5 years, while its market cap has increased by roughly a multiple of 6.78. This indicates a diminishing return on the energy used to mine Bitcoin. Keep in mind, due to Bitcoin being a volatile asset, this comparison was significantly different at the end of 2021. In November 2021, Bitcoin had a market cap as high as $1.26 trillion. This made for a market cap multiple of approximately 16. At the time, Bitcoin's energy consumption multiple stood at approximately 12.25. Both these multiples are measured from August 2017 to November 2021. Therefore, only 9 months earlier, the relationship was the inverse of what it is today, August of 2022. The relationship between Bitcoin's value and energy consumption is clearly a volatile relationship and something that should only be extrapolated into the future with extreme caution. Chapter 4: Arguments for Bitcoin. Bitcoin has the potential to do a lot of good. It also has the potential for abuse. It really comes down to, as is the case with most things, the user. This, in turn, comes down to human nature, which is a good segue for this book to veer into the topic of God created the world and then there was man. As important a topic as that could be in this book, Bitcoin holds the precedence. Because as much as there is wrong with the world, there's always the possibility of a disruptive technology like Bitcoin that could come along and set it back on track. Or not. This chapter won't be in the business of making predictions. It will, as its predecessors have, simply be stating the facts, and the facts are quite mesmerizing. Socioeconomic liberation potential. When the U.S. housing bubble burst in 2008 and sent the system into financial disarray, it showed to those that were watching that the system can indeed fail for us. For a system to work, the government needs the faith of their populace. Fiat is what fuels a socio-economic system. It is essentially a promise by the government to its populace that the piece of paper they are presented with is viable for the exchange of goods and services. Therefore, fiat will not work if the people do not trust in their government. A currency is generally considered a store of value. It was true for gold back when the gold standard was still going, but it is not true for fiat. Fiat leaks inflation every day. Inflation erodes the purchasing power of a currency. It makes it less valuable and, therefore, a terrible store of value. Inflation is the result of many phenomena, a lot of which is government-induced. Money printing, tariffs, quotas, capital control, and protectionism are all causes of inflation and are all government-induced. Bitcoin had been introduced as a vehicle in which to break away from all central control and incompetence. It is a socio-economic liberator with the depth of an abyss and the substance of a blue well. And most importantly, it does not leak value. On the contrary, it stores all sorts of value. Its greatest value is in it being the one asset that is invulnerable to the perils most other assets are. Physical assets can be destroyed, worn down, or forced to be left behind. All financial assets are another's liability. Their value is dependent on the financial health of the debtor. Bonds and stocks will see their value disintegrate in a matter of days in the case of extreme corporate malfeasance. Assets and bank accounts can be frozen by the push of a button if your actions are considered out of line, or in the case of the Russian oligarchs, simply by association. A country's dollar reserves can essentially evaporate into thin air if the US government is simply not liking what they are doing. Each asset, whether it be physical or financial, is at the mercy of either another, a government, or some natural element. Bitcoin is insulated from all these things. To argue the effect market forces have on the price of Bitcoin would be missing the point. Bitcoin cannot wane from age. It cannot be compromised by the government. It is not the liability of another, and it cannot be taken out by a hurricane. The only thing it needs to keep it going is faith in what it provides. Consider the Russian invasion of Ukraine. Even when the Russians were stacked all along the Ukrainian border, very few Ukrainians believed an invasion to be realistic. The next day, they found themselves refugees, their physical assets either left behind or turned to rubble. Any locally held financial assets will have seen their value tank to the bottom of their price chart, while the Ukrainian Hryvnia painted a similar picture. Every refugee suddenly found themselves in a financial crisis of their own and in a foreign land with no possessions and no bank account to survive with. The European banking sector reacted by simplifying the process of opening bank accounts for Ukrainian refugees, as well as other supportive measures to accommodate their grisly situation. Countries and unions have not responded so supportively in the past to refugee flows. Why this time around was different is besides the point. The point is, if the European Union had not responded in the way they did, but rather responded barely at all, Bitcoin would have. It would not have seen its value plunge like their financial assets and currencies. Bitcoin's value actually rose in the first month of the war. It would not have been left behind like their physical assets, and had it not been simplified for them to open a bank account in another country, but rather next to impossible, they could have simply exchanged their Bitcoin at a crypto ATM. There are other means of doing this, for the local currency. Had they not had any Bitcoin, they could have downloaded a wallet to which it could be sent to by either family or friends. When activists and dissidents want to start a movement against an authoritarian regime, they can easily be immobilized by the government cutting them out of the economic system. When the Canadian truckers started protesting against the mandatory vaccine shots, they raised donations, but shortly after got cut off by the government in a country known to be one of the most liberal democracies in the world. They branded it as a threat of some sort. This action was a big monkey wrench thrown into their cause. However, there was one group that raised their funds in Bitcoin and managed to distribute some of it before the Canadian government managed to procure an injunction for handling over the remaining Bitcoin. There are two things to be taken away from this. Firstly, one of the most liberal democracies in the world staged an act of anti-democracy by freezing the funds without having gone through the proper channels to do so. If a government of the Canadian government's democratic status is willing to cross the democratic line, one can be sure other governments would have no problem following suit if what is being done by their populace is of an unsavory enough nature for them. Secondly, although they still managed to preclude the truckers from continuing the protest, they were forced to go through a much slower, conventional channel to get it done, giving the funds raised time to at least have some effort on the cause. The free flow of capital in and out of an economy is restricted by many governments around the world under the notion of keeping an economy safe from mass capital flight in times of crises or mass capital influx in times of great speculation. But it also distorts the realities of an economy, assaults the concepts of free market, and as most things government-related tend to go, causes inflation. Bitcoin has the ability to bypass capital control and revitalize the flow of goods and services across borders. Many countries hold dollars in their reserves in the form of treasury securities as a means of storing their national earnings, diversifying their reserve account, and mobilizing the securities to counter certain economic events. At best, holding U.S. treasuries in a reserve account is only good for two of the three means. It is a subpar store of value at the complete mercy of U.S. policies and their boundless money printing and debt issuance ethos. Furthermore, for some countries, it is basically a Trojan horse sitting in their sovereign basements, waiting to be unleashed on them the day the U.S. government decides they don't like them when they're not playing ball. In 2021, the dollar as a reserve asset of central banks around the world hit a quarter of a century low, while in 2018, central banks had bought more gold than at any other time under the existing international monetary order. The trend continued into the first half of 2019. This recent shift in reserve asset interest is a result of several factors, one of which is the de-dollarization policy as a reaction to the dollar being used as a sanctions weapon in the materialization of a new geopolitical environment. Gold is considered the best alternative, but has challenges of its own. Costly to store and hard to move, among other things. Bitcoin has many of gold's benefits and fewer of gold's costs. Therefore, it has all the makings of a reserve asset while keeping it clean on the cost side. The different types of values of Bitcoin, social and economic, are not always clear when one has yet to have taken the time to really think about everything it offers. Normally, a problem isn't a problem until it has manifested itself, and only then do you start thinking of solutions. In this chapter, only a few Bitcoin use cases were mentioned. These examples manage to capture the essence of what Bitcoin offers, but there are still many more examples of where Bitcoin either assisted or could have assisted positive change in either a humanitarian or economic context. People in developed countries have the privilege of living in a society with strong property rights, a well-functioning legal and financial system, and a stable currency. Those that live under the authoritarian regimes, which is the majority of the world, do not have any of those things. Bitcoin is a lifeline for these people. It is a type of property that cannot be taken away from them. It lives as a well-functioning financial system, the blockchain, and does not experience a massive currency devaluation over short periods of time. Bitcoin has a practical value, and that is immeasurable, a value that makes it invaluable. Fort Knox blockchain. In previous chapters, it has been discussed what Bitcoin has proved invulnerable to. By now, it should be understood that Bitcoin exists outside of our physical world and financial system. This insulates the cryptocurrency from many known external forces. Bitcoin resides in a realm called cyberspace, but it is not the only resident of cyberspace. Some residents exist to inflict positive change, and others live to inflict harm. Those that live to inflict harm are militants of two breeds. The first breed is of a minority with, at times, a decent cause. The majority of them are malicious actors with a cause no more than to serve themselves. Since Bitcoin is of a decentralized nature and has no one single entity to look over it, Satoshi had to come up with a way for Bitcoin to take care of itself, as it were. The Bitcoin had to be made unhackable by design. Satoshi achieved this by building a function into the blockchain called a hash. But the truth is, the protocol has an extra natural layer of protection coded with good old-fashioned economics. This layer is all that needs to be mentioned when debating Bitcoin's vulnerability to hackers. It's a very simple concept rooted firmly inside the shooting yourself in the foot idiom. The repeated hacking of Bitcoin will damage the reputation and credibility of the cryptocurrency. Bitcoin would see its value drop to zero in a heartbeat. A once-off hack is unlikely to be economically feasible for the actor, so no dice there either. But let's say the hacker is irrational and just wants one good run, spending the Bitcoin in a flash and experiencing the ephemeral feeling of having written a song like Spirit in the Sky. This is what the hacker would have to do. Hacking the blockchain would require a successful interference with its built-in hash function. The hash is a string of 256 bits. The desired hash has a certain amount of zeros as the first numbers of the string. The amount of zeros establishes the magnitude of work necessary to come up with the resulting hash. The number of zeros varies at any given time as the network adjusts the target difficulty to maintain a constant rate of block addition to the blockchain. 10 minutes per block. Hashing a block is a tedious process of trial and error in which messages of variable length and arbitrary composition are run through a cryptographic hash function by the network's miners. It requires a large amount of computational effort, with each single trial having little change of success. Once this hash is found and the code is, so to say, cracked, the block becomes eligible for addition to the blockchain. Eligibility stems from the proof of work concept, which is directly related to the amount of computational effort put into creating a block. It acts as the consensus mechanism of the blockchain and can be verified by other nodes and users by inserting the message that is consistent with the hash into the hash function. The nature of the hash function is such that the message cannot be reverse engineered by using the desired hash to generate the message that is consistent with the hash. Just like with a meat grinder, where there is no way of putting the mince back to make the steak, you cannot reverse engineer the message. This salient feature protects the credibility of the blockchain protocol. Blocks are only accepted on the blockchain once verified. Users hear of these blocks being broadcasted and update their own personal copies of the blockchain with these new blocks. Each block's hash is unique to that block. The hash is what identifies the block. By changing the content of the block, the hash will change as well. It is likely that the hash will no longer meet the required proof of work, forcing the hacker to redo the hash. Furthermore, each block references the hash of the preceding block. Therefore, changing the hash of one block would result in having to redo all the hashes of the blocks that succeeded it. This would require massive computational effort to achieve and sustain indefinitely, a continuance of deceit for as long as the cryptocurrency exists. Remember, there are several blockchains in existence, but it is the longest blockchain that holds the precedence as it contains the greatest proof of work. For the hacker to continue this deceit indefinitely, the hacker would need more than 50% of the hashing power to keep the longest blockchain running. Once it is surpassed by another blockchain, it falls out of favor. Having more than 50% of the network's mining power, known as hashing power, enables an entity to perform what is well known in the Bitcoin community as the 51% attack. It allows the entity to disrupt the network in several malicious ways. The entity can circumvent the double spending preclusion, block and cancel transactions, and monopolize the network. The entity cannot alter the amount of Bitcoin minted per block, reverse others' transactions, prevent transactions from being broadcasted to the network, bring new Bitcoin into circulation, or steal Bitcoin from other users. Double spending can be achieved by tampering with the consensus block. This can be done privately and broadcasted to the network once it is the longest blockchain in existence. The entity would be able to exclude all Bitcoin transactions it had made in the past, erecting the illusion that it owns more Bitcoin than it actually does, and enabling it to spend the same Bitcoin all over again. This action becomes harder the further back the transaction go, as it would require redoing all the succeeding blocks. With regards to the feasibility of such an action, it all depends on how much Bitcoin there is available for the entity to double spend. Once the tampered blockchain is broadcasted to the network as the longest chain, the rest of the miners will shift toward adding blocks to the new blockchain. Excluding and canceling transactions is also possible when owning over 50% of the network's hashing power. Excluding a transaction is the self-explanatory act of not including a transaction block in a block. Canceling a transaction is splitting the blockchain of a single user by starting a competing chain which is only being broadcasted to that specific user. The competing chain includes a transaction and should theoretically outpace its rival, owing to the majority of the hashing power going into its continuation. The transaction will likely be supposed payment from the hacker to the user, with the competing chain outpacing its rival. The actual legitimate chain, the user will be placed under the illusion that the transaction had taken place. However, with the rest of the network unaware of this alternative chain, no such transaction will show to have ever occurred. The user will have been duped from whatever the supposed payment was for, and the network consensus will continue as though it never happened. The hacker could also refuse to accept blocks created by other miners, eventually driving them out of business and further monopolizing the network. This is also a means of transaction exclusion. The main determinants that keep a 51% attack at bay today is the sheer size of the Bitcoin network and the pledge amongst nodes to keep the network pure at all costs. The latter doesn't necessarily say much, as a good amount of skepticism is always healthy, but the former carries significant weight. The magnitude of the network acts as a deterrent to obtaining more than 50% of the hashing power, as it would require a huge investment in resources, hardware and energy, estimated at just over $15 billion. Even with over 50% of the hashing power, maintaining the longest blockchain would require some luck, owing to the randomness of block creation. Therefore, in order to eliminate this randomness and ensure success, the entity would need significantly more than 51% of the hashing power, resulting in additional costs. The benefits are also unlikely to outweigh the costs. Approximately every 10 minutes, a new block gets added to the blockchain. This makes for a very small range in which the hacker can enter to start creating its own fraudulent blockchain on the side, limiting the ability to double spend and resulting in a possible break-even shortfall. With this deterrent, it is likely more economically viable to continue mining while sticking with the protocol than trying to attack the system in a profitable way. Presuming we are dealing with the rational economic actors on the blockchain with no nodes, having some personal vendetta against Bitcoin, users can feel confident that the 51% attack will stay in its textbook and never see the practicality of real life. Finance with wings. Imagine there's no countries. It isn't hard to do. Nothing to kill or die for, and no religion too. John Lennon. John Lennon was a legendary musician and peace activist. Do you think he would have been a Bitcoin advocate? Recall what had been touched on in subchapter Socioeconomic Liberation Potential. Had Bitcoin existed in Lennon's times, could his song Imagine have been about it? Let's take one line in the above excerpt. Imagine there's no countries. If there were no countries in this world, but say only one country, how many currencies do you think there would be? Likely only one. Imagine not having to ever check the exchange rate when you're looking to go on holiday overseas. It is simply not a factor in your vacation planning. Imagine your currency is rock solid, never losing value. Imagine being always able to transact without the friction of foreign exchange, Forex, wherever you are. These are the features Bitcoin offers a currency. With Bitcoin as a currency, money will flow freely across borders if that is what the people want. There will be no need for the capital control because there will be no conversion from one currency to another. When capital leaves a country, it needs to be converted into the currency of the country it is relocated to. Bitcoin gets to stay Bitcoin no matter where it goes. In this manner, Bitcoin has already started to theoretically remove the borders of countries and integrate the global economy to a degree never seen before. It is in the midst of creating a sort of de facto economic union among the global populace in which governments have no control over how money gets moved around. Currently, this is still something happening at a very small scale, as only 1.3% of the global population is estimated to own Bitcoin. From January 2017 to January 2022, the number of monthly active addresses on the Bitcoin network has mainly oscillated between 18 million and 35 million. January of 2022 recorded an all-time period low alongside the January 2017 number of roughly 16 million. Blockchain.com shows a 695% increase in their Bitcoin wallet users over the same 2017 to 2022 period. This growth rate equates to a 47.37% compounded wallet increase per year. Despite the significant growth in wallets, which generally translates to users, monthly wallet activity has remained roughly the same over the last 5 years. From these statistics, it can be surmised that people are starting to use Bitcoin less as a currency and more as a long-term asset. Bitcoin is a peer-to-peer network of independent nodes scattered all across the globe. These nodes operate independently from one another and have only one function: to serve the network. This decentralized structure makes the blockchain radically different from any financial intermediary. Up until 2009, banks have been absolutely necessary to act as a trusted third party to facilitate electronic transactions. Bitcoin was introduced as a system with no need for trust among network participants, as trust and guaranteed payment is built into this system. The elimination of the need for trust also eliminates many of the costs banks inherently face. Some of these costs are considered inherent weaknesses in the organizational structure of a financial intermediary. One of them being the cost of acting as a mediator between parties with the option of transaction reversibility on the table. It is not something that can be streamlined away. It sits as an extra layer of cost for the bank, as well as the client, and complicates the anatomy of a transaction, erecting a threshold under which the size of a transaction is no longer practical due to cost. This hinders the option for small, casual transactions between people. It also opens up a window through which customers can defraud merchants with all sorts of creative stories told to their banks. Ironically, this is exploiting exactly what the reversibility option looks to combat: erroneous transactions. When a user transacts in Bitcoin, it flows through one channel with no opening to intercept the information. Other electronic payment systems are different. Credit cards have several parties through which a transaction flows, heightening the probability of card information interception and augmenting the cost of the transaction with each additional party it passes through. Essentially, what is being said is that credit cards are more expensive and less secure than Bitcoin payments. Bitcoin payments are generally done at very low fees. For merchants, credit card transactions charge a per transaction fee consisting of a fixed rate between 1.5% and 4% per transaction, plus an additional flat fee, depending on the service provider being used. Merchants have started to accept payment in Bitcoin to not only provide their customers with an additional payment option, but also to alleviate themselves from the per transaction fee they face. Some merchants cover their per transaction fees in the pricing of their products and services. Therefore, it is likely that the credit card holder will end up paying these fees instead of the merchant. Foreign transactions get charged additional fees to the cardholder, debit or credit. This charge is around 3% per transaction. Bitcoin is border agnostic. Its transaction fee is completely unrelated to the geography. Foreign transactions are also a lot slower when done through a bank due to bank protocols, especially for large amounts of cash. Average wire transfers in the United States average about $26 for domestic outgoing wire transfers and $42 for outgoing international wire transfers. Transactions through banks become more costly the bigger they get. For example, a fixed rate charged to variable amounts with usually a floor fee as the transaction minimum. Bitcoin transaction fee is a variable amount independent of transaction size. It varies with how the network's total hashing power and infrastructure matches up with the amount of transactions being broadcasted. Both of these factors are improving as the blockchain grows in popularity. However, even in the early stages of blockchain technology development, the fees have shown to be significantly less than banking fees. As a result of a mismatch, Bitcoin has, at times, seen its transaction fee spike in tandem with its volatility. These volatility spikes should ease as Bitcoin matures. However, even as a volatile asset, Bitcoin's transaction fee has generally been well behaved over its life. It has hovered south of $2 approximately 83% of the time since inception. At the time of writing, Bitcoin's transaction fee stands at $2.09, which was 0.009% of its value. In August 2017, its transaction fee was $1.96, which was 0.047% of its value. Therefore, as a percentage fee, Bitcoin's transaction fee has dropped by 80.1% over the last 5 years. There have been 2 outlier periods in Bitcoin's transaction fee history. The first outlier period started in October 2017 and ended in February 2018. The transaction fee peaked at $54.64. The second outlier period started in December 2020 and ended in July 2021. The transaction fee peaked at $62.79. This seems like a nauseating amount to pay per transaction, especially for smaller transactions. However, the only reason this happened was because the network infrastructure and hashing power were struggling to keep pace with the transactions being broadcasted. These radical increases in transactions broadcasted cannot be solely attributed to volatility. Bitcoin has been volatile its whole life, but approximately only 17% of the time has Bitcoin's transaction fee traveled north of $2. By pulling up a price chart, it is clear to see that in the first outlier period that Bitcoin's value had increased by approximately 4.17 times. The transaction fee went up by approximately 16.2 times. Therefore, it can be surmised that the transaction fee spiked had been largely driven by a demand rush for Bitcoin, which showed up as a heightened network activity. Had the increase in Bitcoin's value matched the increase in the transaction fee, one would have immediately been put at ease. However, looking at the second outlier, you'll feel yourself getting there. In the second period, Bitcoin's value went up by approximately 3.42 times, while the transaction fee went up by approximately 7.75 times. This is already a significant improvement from the first period. Empirical evidence confirms an abnormal spike in the transaction fee is associated with an unprepared increase in network activity. However, it is a problem that shouldn't cause too much sweat, as the blockchain's open source developer community has been rapidly tackling this problem upon emergence. Once again, we also have good old-fashioned economics, allowing for much of it to sort itself out. In the case of economics, transaction fees led to more miners joining the network. Since both components of their compensation have seen a significant increase in value, the transaction fee and the value of Bitcoin, more nodes mean more hashing power, which brings transaction costs down again. It's the same mechanism as any free market. Profitability attracts companies and competition brings prices down. Once Bitcoin has progressed through its infancy phase and growth starts to moderate, there should be no more transaction fee spikes, owing to a good balance between hashing power, network infrastructure, and network activity. The second Bitcoin 2021 price surge that peaked in December 2021 at $68,773 was not accompanied by an abnormal spike in the transaction fee. It stayed down because the network had already adjusted to the new level of network activity from the first 2021 peak of $64,917. Bitcoin has long been critiqued for the infeasible amount of time it takes to process a simple transaction. Each block takes on average 10 minutes to mine. Thereafter, the user would normally wait for another 5 blocks containing the transaction to confirm its legitimacy. As a result, it normally takes about an hour before a transaction can be confirmed. The speed at which transactions are confirmed, like the transaction fee, is highly dependent on how the hashing power and infrastructure matches up with the network activity. In the 2017-2018 outlier period, the average transaction confirmation time reached a level of 1,188 minutes. This is simply not practical. In March 2018, the first version of a solution known as a Lightning Network has been ushered in. The Lightning Network forms a continuum with the blockchain, acting as a second layer created by users in which they transact privately in. This allows them to circumvent the network traffic and, therefore, keep transactions quick and cheap. Anybody can open a Lightning network. All you need is some Bitcoin to get started. It is also scalable as these layers can overlap one another, creating a beautiful nexus of connectivity hovering above the actual blockchain if the users desire it. For example, Party B has a payment channel open with Party A and Party C. Party A can easily then transact with Party C without having to create an additional channel, especially for their transacting. Once the channel is closed, the transactions are consolidated and broadcasted to the blockchain. To give some context on the difference in speed and cost, it is said that the blockchain is capable of handling about 7 transactions per second. Desiree Dickerson, Lightning Labs vice president, claims the Lightning Network is capable of handling 25 million transactions per second at a cost of 4 cents per transaction, monumentally greater than Visa's 1700. Other literature brings it down to 1 million transactions per second. Even if the former is just a hyperbole, it matters little since the improvement has made the transaction speed and cost infinitesimal. Fees equivalent to Bitcoin's transaction fee are paid on opening and closing the channel. However, for channels that are kept open for long periods, these fees are insignificant. Because of the transaction fees to open and close a Lightning network, it is only feasible to do so for users that conduct regular business with certain entities, as well as for small transactions where the transaction fee becomes a significant portion of the amount transacted. Those that transact in large amounts and sporadically, with the majority of these businesses being once off, would prefer using the blockchain over the Lightning network. It is cheaper to do so because it requires a transaction fee being paid only once, as opposed to the Lightning network that requires a transaction fee payment upon opening and closing the network. The Lightning network is available to anyone to use and can be created by 2 parties depositing Bitcoin in a 2 of 2 multi-sig address, an address that requires both parties' signatures for the transaction to be valid. The opening deposit is recorded as a transaction on the blockchain. Once a transaction is confirmed, the Lightning network is opened between the parties. Upon closing the network, the debit and credit between the parties will be settled up using the deposited Bitcoin. These settlement amounts will be recorded on the blockchain. A friend of energy. Bitcoin is said to be terrible for the environment, owing to the amount of energy it consumes and the amount of energy it wastes. Normally, it is left at that. The former is not debatable. The latter is debatable. Although it is true that not all energy consumed by the blockchain network is converted into blocks, it does contribute to the network's hashing power, which makes a 51% attack less likely. Therefore, the largest majority of the network's energy consumption goes into the security of the blockchain, which is by no means a waste. Currently, mining Bitcoin does not consume a lot of energy, more than any other cryptocurrency, but there's more to Bitcoin miners and how they interact with the biggest line item on their expense sheet. Most companies' power expenditure makes up roughly between 20% and 30% of their total cost. For Bitcoin miners, this number is closer to 90%. Bitcoin miners are no different from any other business as they too are looking to make a profit. Profit isn't just about the amount of revenue you are generating, but also about how well you are keeping your costs in check. It would be ill-advised to think Bitcoin miners don't care about the amount of energy they are using. Bitcoin is still developing and finding its place in the world. Efficiency doesn't always happen overnight, especially with a disruptive technology like Bitcoin, but as it becomes more integrated into society, so too can it be expected to become more harmonious with society. Miners are among the greatest stakeholders of energy grids around the world. Many grids have grown old and unhealthy from underinvestment and neglect. Most investors pull up their noses when they hear about the utility industry. To them, the industry lacks upward mobility and is oversaturated with regulation and subsidies. These factors have cultivated complacency and inefficiencies within the industry, tying back to grid age and illness. Capital has long since not flowed freely to this market as it is not a free market. With a cap on profits, investors have no interest in the industry, nor is the health of the industry or the grid much of a concern to them. Bitcoin miners could not be any more different. They live and breathe off the grid. Grid health is paramount to them. In 2022, at the annual Bitcoin conference in Miami, miners spoke of their mentality toward a grid and how they see themselves easily becoming one of the biggest benefactors of the energy industry, as well as spurring the move to a free energy market. Bitcoin has recently set its eyes on a new phenomenon that has been causing intermittent energy providers, solar and wind, bus-pounding headaches as of late. The phenomenon is known as the duck curve, a visual representation of how intraday demand for power overlays with the energy being generated throughout a day. In the context of solar power, there is a big supply-demand imbalance throughout a day, which causes volatile energy prices, unutilized energy, and financial difficulties for intermittent energy providers. From about 8 to 5, most households are relatively dormant. The kids are at school and the adults are at work, resulting in a low demand for household power. This is also the time of day when the sun is at its strongest, making solar power cheap and abundant. As the sun sets, solar becomes the opposite, scarce and expensive. As this is happening, people are coming back from work and basically switching their houses on. For example, the oven is on, the lights are on, the television is on, and the computer is on. Everything is on, and everything is drawing power. This daily divergence in supply and demand puts severe strain on the grid and forces power providers to draw from the base energy load. The majority of base energy sources, such as coal and gas, are pollutive. Throughout the entirety of this phenomenon, a double whammy occurs. The environment takes a hit, as well as the entities that provide the clean energy. With energy storage technology still infantile, requiring many more years to become significant, Bitcoin miners offer an immediate solution to the problem. Bitcoin mining has an extremely flexible business model that allow them to operate in tandem with the energy supply of intermittent providers. They are every grid operator's dream, as they are what is known as both an interruptible load and controllable load. Interruptible load means that miners, unlike most players of other industries, have the flexibility of shutting down their operations by simply flipping the switch on their equipment. They do not face the fixed costs and stickiness other industries face that preclude them from simply hitting pause on their operations. This flexibility allows miners to restore an equilibrium in the supply-demand relationship of energy by juicing up their operations when energy usage demand is low and curtailing their operations when demand is high, thus stabilizing prices, flattening the duck curve, and making it more predictable. Being an interruptible load means miners can be a controllable load as well. Instead of grid operators having to try to respond with more supply when demand spikes, they can rather manipulate demand by requesting that miners bring their energy usage to a level that is comfortable for the grid to accommodate. This option means that fossil fuel, your more reliable baseload power, does not have to be tapped into so often. Miners are already enrolling as controllable loads. The 2020 State of the Market report from Electric Reliability Council of Texas, independent market monitor, shows 100 megawatt worth of Bitcoin miners have enrolled as controllable load resources. To summarize, the effect of Bitcoin miners being both an interruptible load and controllable load is as follows: monetizing intermittent energy that otherwise would have gone unused, mitigating the strain put on the grid, and improving grid health, stabilizing the price of energy, increasing the profits of intermittent providers that can be reinvested in further innovative industry technology, driving down costs with deflationary effects for the end consumer, and curtailing reliance on fossil fuels. State-regulated energy systems, which are mainly fossil fuel-oriented, have the benefit of various subsidies that lock in profit margins and disincentivize streamlining and investment that generally have disinflationary effects for consumers. The government keeps prices artificially low, with these subsidies acting under the misconception that they are protecting the consumer and the industry from unfavorable price movements. This could not be further from the truth. When profit margins are locked in and subsidies are certain, companies become very inefficient very fast. Competition in a market like this is slim, and it is competition that drives prices down. A further issue is that these subsidies are done with fiat, and the printing of fiat, which is inflationary, miners can essentially be seen as having the ability to subsidize intermittent providers with profits when monetizing excess energy, while staying true to the workings of a free market. In this free market, one will see the true market value of energy for the first time. Bitcoin miners, therefore, have the potential to assist in the development of a free energy market and will prove crucial to the profitability of intermittent energy providers over the short to medium term. Furthermore, free markets and profit attract investors through which capital flows into companies for further innovation and investment, resulting in better technology and more potential deflationary effects for the end consumer. Another flexibility aspect of a Bitcoin miner's business model is fluidity. Bitcoin miners, like gold miners, are not forced to consume whatever form of energy is available in the area. They have the ability to relocate to wherever there are load imbalances and renewable energy is cheap and abundant. They also have been found to relocate to where large amounts of methane is being released. With the new clean energy transition, a climate-friendly activity known as methane capture has emerged. Methane capture is done by capturing the methane released in industrial activities and using it as energy. Bitcoin miners have moved to where methane is being released, but considered unprofitable to capture. Many oil companies do not find it profitable because of the lack of supporting infrastructure. Therefore, they rather flare the methane, which converts it into the less pollutive carbon dioxide. Being close to where the methane is released, miners are able to capture the methane and use it in a less carbon dioxide intensive way than flaring. Flaring also requires energy to burn the energy-rich methane. Bitcoin miners simply use the energy-rich methane. There are also many places in the world that are rich in energy sources that cannot be used due to a lack of surrounding infrastructure and the infeasibility of transporting that energy to where it can be used. Thanks to miners and the portability and limited need for infrastructure, they have the potential to tap into that energy. This energy can be stored in Bitcoin and eventually monetized, basically bringing additional inflation-free money into the global economy. There are many areas where manufacturing projects have been abandoned, leaving electrical infrastructure behind. Because this infrastructure is not being used, it has seen its market value drop to virtually zero. A good example of this phenomenon is America's Rust Belt, which has seen an industrial decline since the 1980s. Bitcoin miners have the option of moving in on these grids and resurrecting them. This resurrection will slowly build on its market value as well as surrounding economic activity, creating jobs and breathing life into something that had been dead for some time. Many of what is mentioned in this chapter is already slowly starting to happen. Bitcoin miners are welcoming the role of being an interruptible load and controllable load. Dialogues are being opened with energy providers on becoming a buyer of last resort and thereby monetizing excess energy. Methane is being captured and thereby mitigating its impact on the environment. Hypotheticals like migrating to abandoned grids and storing energy seems very plausible. There is certainly a potential place for Bitcoin in the clean energy transition. Chapter 5. Popular media's response to Bitcoin. With Bitcoin having exploded onto the scene in recent years, many prominent individuals have developed an opinion on Bitcoin. Business tycoons, programmers, environmentalists, philanthropists, investors, Hollywood moguls, the works. Everybody has an opinion. What is interesting about these opinions is that from every mind, Bitcoin is seen a little differently. Of course, there are large parallels owing to the laws of many fields, but because of differences in backgrounds, personalities, expertise, biases, and beliefs, many of these views on Bitcoin have been shaped into a nuanced way. Michael Saylor is potentially one of the most prominent names in the Bitcoin community. 3 years ago, most Bitcoiners had no clue who Michael Saylor was. It was only in August 2020 when Saylor's company, MicroStrategy, started adding hundreds of millions of dollars of Bitcoin to its balance sheet that the community took notice. MicroStrategy was sitting on a pile of cash, thanks to the pandemic having cut a lot of their costs. With the issue of finding an appropriate vehicle to park it in, Saylor came to the conclusion that Bitcoin is the ultimate store of value. He had fallen so in love with what he had found the cryptocurrency to promise that he started pumping billions of dollars into it. The cost value of MicroStrategy's Bitcoin investment was roughly $4 billion at the time of writing. What is interesting about this is that the company is not generating an amount of cash commensurate with the magnitude of Bitcoin they're buying. Although generating positive operating cash flow, MicroStrategy is relying mostly on external capital, stocks and bonds, to fund their Bitcoin purchases. In MicroStrategy's latest quarterly report, Bitcoin can be seen to make up approximately 77.4% of the company's total assets. Overlaying MicroStrategy's stock price chart with Bitcoin's price chart for the last 2 years will show a staggering resemblance in movement. In May 2021, it was reported by Bloomberg that MicroStrategy's share price has reached a 0.81 correlation with Bitcoin. What is it about Bitcoin that caused a tech billionaire to step so far away from the status quo to turn his company into basically a holding company for Bitcoin? Saylor believes the longevity of Bitcoin is far superior to any Fortune 500 company today. He has taken a long-term bullish view on the cryptocurrency with acute mindfulness for the future in place. Saylor praises Bitcoin for being the first bona fide digital property put in cyberspace, a revolutionary event that will purge cyberspace from the toxicity of Web 2.0. Think of Bitcoin as a property today in terms of Manhattan property 100 years ago. Over the last century up to 2020, Manhattan property has grown roughly 24,067% in value. The property value of an area goes up the more people flock to it. For the property industry, a 24,067% increase is a top-tier return over the span of a century. The problem with Manhattan is it can only take so many people. Today, 1.3% of the world has flocked to Bitcoin City. Imagine what the value will be when 50% have. It also has the additional tailwind of no logistical or spatial barriers, meaning that theoretically 100% of the world could live in Bitcoin City. The physical parameters of a city does not apply to cyberspace. The 21 million Bitcoin cap does not necessarily mean everybody cannot live in Bitcoin City. Bitcoin increments are being bought and sold every day. Saylor's view of Bitcoin as a property is far superior to Manhattan. He calls it the apex property of the human race, owing to its portability and no need for management nor maintenance. He also views it as the treasury asset of the crypto space, with all other cryptocurrencies as venture capital. This is a very powerful statement, as it conveys a certainty no other crypto does. To him, Bitcoin is more a sure thing than anything else in the world. A large Bitcoin holding has also proved to be very synergistic with his company. Bitcoin has carried MicroStrategy's stock price along with it. A greater stock price increases company size and status, resulting in a type of costless marketing and improvement in customer relations, employee relations, and employee recruitment. Saylor does not consider Bitcoin a currency, nor for it to ever become a currency. He says its hostile tax treatment is in line with property and stocks, a type of tax treatment from which fiat is exempt. It shows that the government is of the same view as Saylor, that Bitcoin is a type of property and not a type of currency. Saylor also says Bitcoin as a currency is too cumbersome for transacting efficiently. Jordan Peterson, a polyglot of industry, best known for his psychological work, has spoken a lot of Bitcoin's transformative effect on people. Inflation is a psychological bane to people, therefore the opposite. An effective store of value, such as Bitcoin, becomes a psychological boon. Another psychological bane to people is a lack of freedom. Bitcoin, an impetus of freedom owing to its decentralized nature and inclusivity, must then be a psychological boon. Most people live under the roof of the government where policies are reactionary and changing all the time. This constant change feeds into uncertainty, which thereby drives physiological instability and mass psychosis. Bitcoin has the ability to restore mass sanity that's exempt from these issues of government. It is a cosmic monkey wrench that has been thrown into the magnification of centralization by governments on a blind path to totalitarianism through policy and action, driven by the gross misconception of knowing what is best. Bitcoin dismantles this path and fragments choice and control back to the people. Conversely, Peterson also admits to being worried about the possible unintended and unanticipated consequences that might materialize if Bitcoin manages to fully dismantle the government. To quote his words, "The probability that you invent something extremely powerful and it only does the things you think it will do, and all those things are good, it's like no, that never happens." He has a clear and logical concern for a potential different socioeconomic disequilibrium from what we have today. Although currently in a disequilibrium, it is a system that has shown to be manageable and to work well enough. One must understand that it is easy to denounce the government for various legitimate reasons, but they still have an important role to play in some areas. The problem is that they sometimes overextend that role, as well as the power they possess. It's hard to say if governments in their pursuit for human welfare knowingly hurt the populace by giving them what they want or not. How much of it is incompetence and how much of it is malice? Notwithstanding that incompetence is not much of an excuse either. If Bitcoin takes over and fiat vanishes, what would that mean for taxation? When one looks to realize the fantasy of government disintegration, many things must first be considered. For example, how will taxation work? Loss of government control over money has the potential to complicate taxation severely. Evading taxes will be a piece of cake with something like Bitcoin, thereby cutting off the government's only revenue stream and immediately putting them out of business, so to say. If the public sector is gone, how will the flow of capital look to potentially unprofitable infrastructure projects such as roads, bridges, and telecommunication in rural areas? And what are the odds of said infrastructure being open to the public rather than privatized by the company to protect their infrastructure from the wear and tear that comes with mass usage? These, among many others, are questions that should be considered in a government-free world. In a free market, ethical behavior pays off. However, greed can easily coexist with ethics, and greed can be a killer of the public. Elon Musk has arguably become one of the biggest shakers of our time. He has this sort of conspicuous renegade attitude to him with an appetite for mild pandemonium as he marches in his maverick suit to the beat of his own drum, while simultaneously beating on the drums of others, theirs with no rhythm nor care. Since Bitcoin has a motley user base, investors, speculators, programmers, humanitarians, and so forth, everybody has their own way of responding to the news on the cryptocurrency. Elon Musk has been an active source of Bitcoin news. Tweets from Musk have at times sent Bitcoin swinging by 10% in one direction or the other. In 2021, these tweets mostly revolved around what Tesla's stance was on Bitcoin. Would Tesla accept payments in Bitcoin? What was Tesla doing with its Bitcoin holdings? Selling, buying, or holding? Musk's greatest concern about Bitcoin is the collision course it is on with the environment. Conversely, he sees a lot of inefficiencies in the current information system that is money, feeling that Bitcoin provides some improvements to this in terms of security and speed. Generally, he's a strong supporter of Bitcoin. Musk owns cryptocurrencies Bitcoin, Dogecoin, and Ether, and has reiterated several times he will not sell any of them. His preference for Bitcoin has come from its decentralized nature, public ledger technology, and rarity. Another critique coming from Musk on what could hinder Bitcoin's momentum is its low transaction volume and high cost. Alec DeVries, founder of Digiconomist, calls the blockchain inefficient by design. He attributes its cumbersomeness to not only the proof of work feature, but also other steps involved in the blockchain network, such as the broadcasting and collection of transactions and the acceptance of blocks only if the transactions in it are valid. However, it is a proof of work feature that is criticized mostly heavily by DeVries. His concern is the energy requirement by proof of work and how it slows down the processing of transactions. Statistics from a 2019 seminar he hosted with regards to proof of work showed that of the 20 quintillion hash operations per second, 2.5 transactions get processed. The banking sector processed roughly 16,000 transactions per second. The energy consumption of one transaction is found by De Vries to be the rough equivalent of what is consumed by a German household on a monthly basis. The rate of change in energy consumption is also somewhat of an excruciating number for De Vries. Bitcoin's energy consumption has gone from basically negligible in 2016 to a multiple of 40 in 2 years. The monetization of excess renewable energy he criticizes as a charade, saying that Bitcoin miners still tap into a harmful amount of baseload energy when intermittent energy dissipates. He says the steep opportunity cost of not running a machine prompts miners to run their machine nonstop, and that the competition on the network is toxic, owing to its main driver being mass energy consumption. The short lifespan of application-specific integrated circuits, ASICs, used by crypto miners is an issue also raised by De Vries. ASICs are tailor-made for crypto mining. Bitcoin ASICs lead to 30.7 kilotons of waste annually and last about 18 months on average. They get thrown out when defunct or a miner chooses to upgrade to new equipment. Sometimes upgrading is done prematurely just to stay competitive. There is further concern from De Vries on energy availability, unable to keep pace with Bitcoin if it indeed does supersede the banking system. Crypto, more so than Bitcoin, has seen a recent shoveling through social media by celebrities. These services are generally solicited by the crypto companies themselves. Not all celebrities directly endorse these cryptocurrencies, but as is with influence and status, you don't have to do much more than bring it up in a positive light to shape a person's view on it. There is a disclosure protocol with the #ad that signals it to be an advertisement, and that dissemination by the celebrity is paid for. In essence, it is an advertisement like any other. In reality, it is something very different. Crypto, like other traditional goods and services, is not something with a stable market value. It is extremely volatile and risky. Therefore, its sunk cost can be severe and have one licking their wounds into perpetuity. This is especially the case with the less established altcoins, unlike Solana and Ethereum. Furthermore, it hardly takes any research to say with relative accuracy that those that follow Kim Kardashian probably don't have the investment prowess to know exactly what they are getting into. Ethereum Max, an altcoin, has been swimming in the lane of a couple of celebrities as of late. Kim Kardashian posted of the issuing company's philanthropic efforts when they burned half of the tokens to give back to the Ethereum Max community. Floyd Mayweather accepted payment in Ethereum Max for his recent fight with YouTuber Logan Paul. Younger influencers found on TikTok and Instagram have also been reeled onto the altcoin bandwagon, waving flyers and flags and blowing on trumpets as it wheels down the internet lane. Influencers post positively about altcoins and suggest them as a good investment. Considering the riskiness of these investments, you might as well be sending the kids off to Vegas to play the slots. It goes without saying that gambling is illegal for minors, but perhaps a reminder is indeed due for some. Kim Kardashian is currently facing a lawsuit for having entered into a pump and dump scheme with Ethereum Max. Chapter 6. Adoption as a currency in the real world. Bitcoin has taken on about every form one can think of, and then some. It seems to have shown to be just as malleable as gold in its versatility. To everybody, Bitcoin means something different. It has made its rounds where it has been considered either bold, stylish, fashionable, a hero, a sin, a trailblazer, a father of crypto, a self-filling piggy bank, and whatever have you. It is a sort of art in its various interpretations by people, at times as obscure as a poem, then suddenly as undeniable as a strike of lightning. As it goes in these many forms, fluid, always changing, yet intrinsically remaining unchanged. It has come to be experimented with by various entities, and already fully adopted by others. Individuals have used it to, for the first time, connect themselves to the financial world and global commerce. It has already been mentioned that activists can leverage Bitcoin to assist them in their pursuit for change, how Bitcoin can keep refugees afloat in their greatest time of need, how for some societies it is an escape from the current monetary system, and for others the entrance to a financial world for the very first time. As a concept of finance, various financial services companies have examined and experimented with Bitcoin to improve their service capabilities, enhance their revenue and the customer experience, and save costs. El Salvador, a little Latin American country nobody had ever heard of up until September 7, 2021, when it adopted Bitcoin as legal tender, had made history by having done just that. Bitcoin has indeed been making its rounds, transforming through interpretation and experimentation. What is miraculous about this transformation is that Bitcoin has undergone no fundamental changes. Yet people are still experimenting with it and educating themselves on the cryptocurrency with the results of the experiments. The more it is tested for various applications, the better it will come to be understood. It is this process that will help Bitcoin find its place in the world and hopefully achieve what it is best suited for. Bitcoin making its rounds, the flow of Bitcoin, individuals and countries. Over the last couple of years, with an outlandish increase in value and possible use cases, Bitcoin has seen its throttle revved time and time again to eventually have it reach galactic status in November of 2021, when it hit $1 trillion in market cap. It took Apple 42 years to get there. For Bitcoin, it took 12 years. Something of this size cannot be ignored by anyone, and so people started responding. Vendors that run e-commerce sites have started to accept payment in Bitcoin. The most frequent purchases made are technology products, both hardware and software, vehicles ranging from luxury to utilitarian, jewelry and luxury watches, subscriber sites, even tickets, plane tickets, and the anomaly of the mix, insurance coverage. Life insurance as a product to be purchased with Bitcoin is yet to be a reality due to regulatory constraints. However, most other insurance products such as annuities, car insurance, disability insurance, home insurance, and so forth are all available to be purchased with Bitcoin. Purchasing sex tapes with Bitcoin has also become somewhat of a favorite among male consumers, very content with the fact that they get to stay anonymous in these transactions. The most convenient way to buy with Bitcoin for the customer and vendor is via a crypto debit card. When using a crypto debit card, the customer pays with his or her cryptocurrency of choice, while the vendor receives payment in fiat. These transactions are made seamless through partnership with payment processors such as Visa and MasterCard. The crypto debit card also allows cash withdrawals from participating ATMs in exchange for crypto. Other means of payment that circumvents the slowness of the blockchain is paying via QR code using your crypto wallet. Prominent American companies that accept payment in Bitcoin are Whole Foods, Burger King, Home Depot, Shopify, Newegg, Overstock, and more. For other big online retailers at which purchasing with Bitcoin is not possible, there's the option of purchasing vouchers with Bitcoin for their stores. Payment system operators like PayPal give U.S. citizens the ability to handle crypto on their platform in whatever way desirable. Convert, buy, hold, or sell. Video games are dropping their physical product share as they become more digitized, which leads to the logical acceptance of payment in Bitcoin for them. Some blockchains like Ethereum are platforms, but also commodities. One can see the Ethereum network as farmland and cyberspace, cultivated for applications to be built on and run from. It's a cyber input as opposed to a raw material. It has the potential to become an inflation driver like any other commodity. Having brought gaming to the blockchain has raised the stakes for gamers like never before. The time put in, the assets accumulated, it all becomes worth something when linked to the blockchain. It allows you to monetize time in a leisurely way and sell off the assets when you get bored of the game. For most companies accepting payment in Bitcoin, there is a benefit that, by far, supersedes the desire to accumulate the cryptocurrency for financial gain. For them, it's about evolving with their customer base, and the evolution seems to be digital cash. Additionally, it doesn't seem so bizarre to say that the effect Bitcoin has had on some people fosters a community that will reciprocate monetarily if they see a company supporting their lifelines by welcoming the use of Bitcoin at their stores. At this moment, it is not that Bitcoin is the most efficient form of digital cash, but rather one of the only forms of digital cash, and certainly the biggest. Many central banks have been flirting with the concept of digital cash. The Federal Reserve, the People's Bank of China, the Reserve Bank of India, and more, to make their own currencies more competitive and embrace the paradigm shift to digital cash. Therefore, Bitcoin can certainly expect some stiff competition in this space in the upcoming years. Malaysians, Africans, and other frontier and emerging country inhabitants with little to no access to the financial system have started to adopt Bitcoin as a conduit to travel the financial realm. Vietnam, Pakistan, and India have seen a Bitcoin detonation in recent years. The Bitcoin mentality in emerging and frontier markets is found to be radically different from developed markets, such as the US, where trading and speculation in Bitcoin is rife. The 2021 Realized Cryptocurrencies Gains by Country Index puts the US on top with $47 billion. The second highest country, the UK, only saw realized gains of $8 billion. Furthermore, the top 4 countries are all developed nations. This is a testimony to crypto being more of an investment than a tool in developed countries. Users in less developed markets have rather been tapping into the practical and empowerment side of Bitcoin. The Chain Analysis Crypto Adoption Index aims to capture the level of Bitcoin adoption by ordinary people with a focus on metrics peer-to-peer trading volume, which excludes institutional and professional crypto buy-ins. Total crypto activity and trading activity of non-professional users. In this index, Vietnam, India, and Pakistan lead the charge in that order. Countries like Vietnam, Kenya, Venezuela, and Nigeria are heavily weighted in the peer-to-peer trading volume metric, as well as on an absolute basis relative to other countries. These countries use Bitcoin as a means of storing value against their debasing currencies, as well as sending and receiving remittances and conducting commercial transactions. Vietnam is the front runner by miles in the Crypto Adoption Index with an index score of 1. The index uses a scale from 0 to 1. The second highest score is 0.37, belonging to India. The reason for Vietnam's score being significantly higher than India's has been attributed to Vietnam's profuse gambling history. The abundant flow of money into Vietnam's gambling industry has left very little for the country's stock market, which led to an underdevelopment still present today. With a depressed stock market and very little interest left in gambling, young Vietnamese don't have much more to do with their funds than buy Bitcoin. Afghanistan's Bitcoin adoption, number 20 in the index, is believed to be because of the difficulty of getting money in and out of the country. For example, capital controls from the recent Taliban coup. In 2021, Africa surpassed North America to become the largest continent in crypto peer-to-peer trading volume in the world. The continent experienced a 1,200% increase in its adoption rate from July 2020 to June of 2021. 7% of transactions of moderate retail size in the continent were done in Bitcoin. The global average for the same period was 5.5%. Attributors were Africa's weak and scarce banking infrastructure, as well as capital controls. Bitcoin transaction volume in Africa is said to account for 1.2% of all transaction volume in the continent. The prospects for Bitcoin in Africa is a reduction of corruption and enriching the lives of Africans, not only through its practical uses, but as an avenue for economic growth, development, and sound governance. However, there are still many challenges on the accommodation side of crypto. owing to low internet availability and shortage in smartphones. Both these issues make crypto wallets inaccessible. In 2019, East Asia had a dominant position in the cryptocurrency transaction volume by region space at a level of 30%. At the start of the second quarter of 2020, that level hit a massive pothole, sending it into a slough which moderated at 14%. This dramatic drop was because of various regulatory moves by China, the economic powerhouse in the region and only second to America in the world. In 2017, the People's Bank of China had banned all crypto exchanges. In April 2020, China started to move toward an outright ban on crypto in favor of its own solutions in the form of a central bank digital currency. In late 2020, they started their regulatory crackdown, and in 2021, they had found their way to crypto mining, which they banned in May of that year. They had also brought the hammer down on trading, suppressing it to an oppressed, minute level. All these events in connection with one another have resulted in the 50% drop in transaction volume for East Asia. Before the crackdown, China was one of the largest Bitcoin mining hubs in the world, controlling 65% to 75% of the global Bitcoin hash rate. During the clampdown, China's share plunged all the way to zero. Subsequent to the May 2021 ban, Bitcoin's global hash rate dropped by greater than 50%. It took 6 months for the global hash rate to recover to its former May high. The natural reason for the crackdown was control and rebalancing China's economic scale in favor of communism over capitalism. China follows an authoritarian regime, and crypto is a threat to that regime, plain and simple. There was a rapid revitalization in China's Bitcoin mining activity, as Canberra researchers found 22% of the global hash rate back in China only 4 months after the ban. Second to only America, which controlled 35.4% of the global hash rate as of July 2021. The Central, Northern, and Western European (CNEW) region reached a 25% portion of the share in global cryptocurrency transaction volume between June 2020 and June 2021, up from 19% and translating into a $1 trillion flow of crypto. The shift was in part due to China's crypto curtailment. However, it was the institutional crypto uptake in the CNEW region that was the significant determinant, especially with regard to crypto staking to generate interest. Crypto staking is the action of lending crypto assets and earning interest on those crypto loans. As East Asia slipped, the CNEW region became the world's crypto hub, reported to be the biggest crypto trading partner of all the other regions. The United Kingdom as the main driver of this activity, and interestingly, it is not Bitcoin that is at the vanguard of this space, but rather stablecoins and Ether, which is the currency used on the Ethereum network. Latin America has seen a lot of popularity in the crypto space for many of the same reasons as Africa: an unstable, underdeveloped financial system, poverty, financial exclusion, and currency debasement. In the case of Argentina, there are multiple exchange rates that exist within the country for the dollar-peso currency pair. Offshore service providers that work in Argentina see the immediate conversion of their dollar earnings to an official rate worth less than half of the market value of the Argentinian peso when deposited in their bank account. This heavy politicization is only one of the many reasons that makes crypto a significantly better alternative in a country like Argentina. What is especially exciting with regard to the case of impoverished and oppressed continents like Latin America and Africa is the prospect of crypto innovation in these parts of the world. Inhabitants of these continents will always understand a completely different side of crypto from their developed nation counterparts. For these people, there is a need for it like there is no other. In developed nations, crypto can be considered a desire. In undeveloped nations, crypto basically becomes a must. When looking at the demographics spectrum of Bitcoin adoption, Even some of the fogies seem to be coming around to the idea of it. 2019 statistics show 1.43% Bitcoin users are over the age of 65. It's not much, but it is good to see that there are a couple of boomers in the Bitcoin mix. Around 50% of Bitcoin users are millennials, and 90% of all Bitcoin users are male. The 90% statistic is due to greater male risk tolerance and the difference in information flow between sexes. The 50% millennial statistic is attributed to millennials having grown up in conjunction with technology and, therefore, having a better intuitive understanding for it than other generations. The same can be said about Generation Z. However, most Generation Z cohorts are still in their early 20s and do not require the level of financial service millennials do. What type of a crypto upheaval are banks facing? The industry that faces the greatest crypto dichotomy is the banking industry, a dichotomy of threats and opportunities. The majority of the banking industry still consider crypto more a threat than an opportunity. The Association of Certified Anti-Money Laundering Specialists found in a study they conducted that 63% of its participants considered crypto a risk that significantly outweighs its reward. Banks feel that handling a cryptocurrency would only serve to sully the prestige of crypto, resulting in a costly hit and miss for the industry. BNP Paribas published a report dissecting blockchain technology and how it could lead to a bank obsolescence, mostly owing to the elimination of the need for intermediation. Crypto is especially considered a threat if banks ignore new consumer behavior patterns with regard to how blockchain technology is being leveraged. The greatest barriers banks face in adopting crypto as a part of their service and offering is absent regulation on the technology. Experimenting with an immature technology with no clear regulatory guidance complicates the two things banks are valued for most: stability and predictability. When those two things start to teeter, the systemic effect could be disastrous. There is, however, the other remaining 37% of the study that feel differently about crypto's risk-reward profile. For them, there is an opportunity to become more digitized and modify existing blockchain technology, as well as remove some of crypto's controversial features, such as irreversibility, by acting as a mediator in retrieving funds from erroneous transactions. American Banker mentions opportunities for banks in the crypto space, such as providing crypto escrow services, issuing loans denominated in cryptocurrencies, crypto savings accounts earning interest, and cryptocurrency conversion into other digital assets and currencies. Banks can also leverage their prominence over other, less established crypto exchanges to act as custodians and assistance providers to more conservative investors looking to enter the space. The Bank for International Settlement sees parts of the banking system disappearing in the future due to blockchain technology, eliminating the need for trust and control over double spending. BBVA sees further disappearance throughout other segments of the system, but rather from streamlining instead of revenue disintegration. Cost reduction will come from there being no more need for each bank to have any array of database servers that hold information equivalent to information held by other banks and institutions when using shared ledger technology. Keeping these databases up to date is a costly process involving a lot of validation and constant intercommunication with other institutions. Shared ledger technology will eliminate the need for the current infrastructure in place revolving around the databases and result in significant savings for the banks. Furthermore, applications such as smart contracts and event-driven programming that previously were considered unfeasible can be built into the shared ledger, enhancing transparency and granularity on customer needs. Big banks have started moving into the crypto space. Citigroup and BNP Paribas have entered into a custodial partnership with digital asset safekeeping firm Metaco. JP Morgan has taken on cryptocurrency exchanges Coinbase and Gemini as customers. They have also created a business unit called Onyx, acting as a blockchain-oriented platform for wholesale transactions. The act of JP Morgan switching from a negative to a cautiously optimistic stance on crypto is encouraging for the sector. Furthermore, big banks like JP Morgan, Citigroup, and the like starting to dip their toes in the crypto waters can be a sort of guinea pig act for medium and smaller sized banks. From it, they can get a better understanding of what works and what does not work. It is more affordable and less risky for big banks to do so, thanks to their size, resources, and access to capital. Any failure should result in minimal financial loss for smaller banks. The loss could be catastrophic. Hanging back and observing seems like the best course of action for small and medium-sized companies in an industry that has never been known for taking big risks. If these ventures by the bigger banks start to pay off, then one can expect a banking influx into the crypto space. Government adoption. A dictator adopting a technology like Bitcoin for his country is the type of satire you never thought to see outside the funnies. Notwithstanding, on September 7, 2021, Bitcoin became an official legal tender alongside the US dollar in El Salvador. This made El Salvador the first country to adopt Bitcoin as a legal tender. The reasons for the adoption was to assist Salvadorans in a transition into the formal economy and facilitate remittances received from abroad to buy the indebted economy. Remittances are particularly important to the Salvadorian economy, with an annual 20% share of the country's total gross domestic product, GDP, over the last 2 decades. Others claim it to have been a move spurred by hubris rather than economics, with President Nayib Bukele looking to solidify his place in world history. Bukele believes it will lift El Salvador out of its debt chasm and drive it to the first world. The rollout entailed legislation forcing all businesses to accept payment in Bitcoin, the government acquiring 400 Bitcoin for their treasury, and the development of a digital wallet called Chivo, Salvadoran slang for cool, compensating Salvadorans with $30 worth of Bitcoin upon download, with access to 200 ATMs and 50 other facilities from which they can make cash withdrawals. Since adoption, there has been a flood of novelties coming through the country's crypto pipeline. Bitcoin has been mined with volcanic energy, and there has been talk of issuing a Bitcoin-backed government bond to provide the liquidity necessary to meet a $800 million principal payment on a government bond maturing bond in 2023. The issuance of the Bitcoin bond will be done through blockchain infrastructure, erecting an unprecedented lending channel for the government, completely separate from international institutions and Wall Street. So far, the Bitcoin bond has failed to attract any investors. About 22% of El Salvador's energy supply is made up of volcanic energy, a type of geothermal energy. Bukele instructed Legio, a state-owned geothermal electric company, to allow miners to dive into the country's volcanic energy resources. Since then, Bitcoin miners have set up a shop at the power plant near Tecapa volcano. Although some interesting developments have come from adopting Bitcoin as legal tender, the move was likely premature and impulsive. With a ranking of 9 out of 142 countries in the Numbeo Crime Index, certain criminal activities such as tax evasion, money laundering, and trafficking are likely to become only more troublesome with the adoption of Bitcoin in El Salvador. Furthermore, Bitcoin is by far still too volatile to use as a currency by a country, a problem that is only exacerbated with a country like El Salvador. It is as good as throwing pig fat in the fire, importing instability into instability. The volatility of Bitcoin crashes head-on with the poverty of El Salvador, where the majority of the population bangs on the lower income line like washing on a windy day. The results of such an action could fall nothing short of a calamity. Most Salvadorans cannot sustain double-digit swings in the value of their currency over the matter of a couple of days. Sure, when it goes up, it's great, but when it goes down, it's a disaster. Bitcoin has mostly gone down since adoption by the country. It was found that 67.9% of Salvadorans did not welcome the move to adopting Bitcoin as legal tender. The majority of the Salvadoran population understands very little of how the cryptocurrency works. Naturally, this severely complicates the adoption and use thereof. Further complication comes from the lack of internet access in the country. Even if the majority of the populace wanted to give it a go, they would be unable to do so. These issues show in a survey released in March 2022, revealing that 86% of the companies surveyed had never conducted business in Bitcoin. International markets have not received Bukele or the adoption of Bitcoin cordially. The country's debt spread with U.S. Treasuries widened by 10% between April 2021 and December of 2021, reaching a record high 14.68%. Longer-term debt has seen more than 70% of its value vanish in this time. Moody's sent El Salvador's credit rating further down the junk status hierarchy with a downgrade in July 2021. The other two major rating agencies, S&P and Fitch, followed suit shortly after in early 2022. The outlook from all three credit rating agencies is currently negative. El Salvador's relationship with the International Monetary Fund, IMF, has soured over the Bitcoin mess, with little hope for assistance in meeting with the $800 million bond maturing in 2023. The IMF feels having adopted Bitcoin as legal tender is a threat to El Salvador's financial stability and consumer security. Other international institutions are equally reluctant to assist for the same reason. In conjunction with these developments, El Salvador's economic growth has plummeted, its budget deficit has widened, its debt to GDP has been predicted to reach 87% by the end of 2022, and acceptance of Bitcoin as a currency among the people has been lackluster. El Salvador can be thought of as a country spearheaded by a blindfolded, cool dictator, man staggering drunk through a college frat house with no economic cognizance as he heads straight for the gallows. This is the best encompassment of public critique the author could come up with to summarize what has been found. On 27 of April 2022, the Central African Republic, CAR, became the first African country and the only second country in the world to adopt Bitcoin as legal tender. CAR is known to be one of the world's most impoverished and troubled nations. The United Nations Human Development Index, an index that measures country prosperity, ranks the CAR at 188 of 189 countries. The CAR has suffered from civil conflict for the last 9 years, with various rebel territories spread throughout the country. The little vitality that the country has come from its mineral extraction in the informal sector. Their adoption of Bitcoin as legal tender was sudden and somewhat puzzling for most. Not much has been said about it on and after the April announcement, which included little more than obscure and bombastic statements such as opening new opportunities for the country, and one of the most bold and visionary countries. Subsequent to the announcement, the president, Faustin Archange Touadera, had been releasing cryptic teases piecemeal over Twitter, which has only spurred further conjecture on the adoption being a political shift away from France towards Russia. The press release had guided people to a murky website that offered little satisfaction or clarity. The website reveals Project Sango to its visitors, a project that resides in the metaverse as a crypto hub to attract crypto aficionados and entrepreneurs, embellished with big bombast, yet very little meaning. It has been interpreted as a tax-free investment sphere for CAR Industries, exempting all participants from corporate and income taxes. There are challenges with Bitcoin adoption in the country that parallels those of El Salvador. Only 11% of the country currently have access to the internet, and very few of them have smartphones. The country's unreliable and limited electricity supply is another issue. Only 14% of the population have access to this electricity supply, most of which is found in the capital, Bangui. The rural areas have little to no electricity availability. Many citizens are skeptical about the cryptocurrency and will need to be educated on it. A shortage of technological infrastructure in the country will pose a problem for widespread adoption. The government is hoping to have fiber optic installed by the end of 2023 to provide the entire country with internet access. The Bank of Central African States, BEAC, denounced the adoption of Bitcoin as legal tender, being the sole proprietor of money issuance and conversion for the CEMAC region. Adopting Bitcoin as legal tender lends itself to circumventing the BEAC's control over money conversion and issuance. The CEMAC region consists of 6 Central African countries that use the CFA franc as their currency. The CAR is one of them. The CAF franc was created as a colonial currency back in 1945. It is backed by France and pegged to the euro. The BEAC put a temporary freeze on CAR's Bitcoin adoption on July 26 for infringing the BEAC's Monetary Union Treaty. Having violated one of the fundamental principles of the treaty, has bestowed on the BEAC the right to expel the CAR from the monetary system of the region. There is a parliament and analyst discord on whether the move from the CAR's president was a political or an economic one. Some feel the adoption of Bitcoin was to assist in a political shift away from France toward Russia by escaping the neo-colonialism in the region. The president also has a desire to change the constitution to run for a third term in office, which is opposed by France. The feeling of France's colonialism is divided. Some believe it serves the region with monetary and macroeconomic stability. Others believe it hampers economic growth. The relationship with Russia started when mercenaries from a society called the Wagner Group, with ties to Vladimir Putin, had been deployed in the country to help fight against the rebels and protect the president from an attempted coup. Bitcoin enables the CAR to funnel money to Russia without the interference of the BEAC, as well as insulate themselves from international sanctions for doing so. The president denies all this, sticking to his story that the adoption was purely an economic one. Companies born from crypto. In 2017, a line that today is so flat on a chart it also seems negligible. Crypto felt the bite of a vicious red ant on its haunches that had it launching straight up into the air, zipping through the Earth's atmosphere and flirting with the moon. Since then, all that line has ever wanted to do was go back to the moon. The line being referred to is a line that represents the size of a total cryptocurrency industry by market cap. Since the beginning of 2016, the cryptocurrency industry has grown from $7 billion to $1.15 trillion, a 16,471% increase, translating into a compounded annual growth rate, CAGR, of 400% per year. Something that is yet to be mentioned in this book and overlooked by many when condemning crypto is the amount of jobs it has created. Jobs related to the blockchain, cryptocurrencies, and Bitcoin is growing at an annual rate of 194%. There is a whole ecosystem of companies that has come into existence to aid the development of the blockchain and digital assets. 4 companies are said to be leading the rise of blockchain technology: Cannon, Riot Blockchain, Coinbase, and Overstock. Each one of these companies are found in a distinguished operating segment of the crypto ecosystem. Cannon is one of the largest ASICs manufacturers used in Bitcoin mining. The hardware used in Bitcoin mining has undergone an evolution of its own over the years. Pioneer Bitcoin miners used centralized processing units, eventually moving on to graphics processing units, then field programmable gateway arrays, till finally converting to ASICs in 2013. Cannon was the first company to create Bitcoin mining hardware using ASICs. Today, ASICs are the only way to profitably mine Bitcoin. The competition and hashing power in the Bitcoin mining sector has become too fierce for, say, a centralized processing unit to be brought back into the space. Other competition in the ASIC manufacturing space, Bitmain and MicroBT, have recently overtaken Cannon as an industry leader owing to superior ASICs. ASICs manufactured by the industry leaders have seen significantly efficiency enhancements in terms of joules used per terahash from 10,000 in 2013 to between 50 and 70 in 2021. Riot Blockchain is a Bitcoin mining company trading publicly on the New York Stock Exchange. It is one of the largest publicly traded mining companies and has a hash rate that makes up approximately 1.7% of the blockchain's total hashing power. Owning about 1.7% of the network hash rate has Riot Blockchain mining approximately 15.3 Bitcoin per day. The company runs a vertically integrated business model, acquiring smaller miners and hosting facilities to deploy their machines at. They have innovated in many of their operational areas, leading to an improvement in the productivity of their mining hardware. a reduction in maintenance cost, and the elongation of their equipment lifetime. Coinbase is one of the world's biggest crypto exchanges. They offer a wide range of products and services such as staking, wallets, analytics, retail and institutional trading, lending, and crypto debit cards. Their custody segment is believed to be the biggest in the world, providing custodial solutions to institutions and high net worth individuals. Coinbase offers one of their platforms to be leveraged as a business-to-consumer educational platform for cryptocurrency issuers to disseminate information on their products to end users. Coinbase also acts as a crypto-backed lender to some of its retail and institutional customers. Although not a company born from crypto, Overtook is a company that has been radically shaped by crypto. In 2013, Overtook was just an e-commerce business in homeware retailing. Early 2014, the company started taking payment in Bitcoin, a good portion of which was kept on their balance sheet. Overtook scaled up its blockchain journey with its subsidiary businesses. The biggest of these subsidiaries are Medici Ventures and T0. Medici Ventures is a venture capital holding company focused on nascent cryptocurrencies. T0 integrates blockchain technology into capital markets. The company offers an increase in the liquidity of capital assets through digitization and the subsequent trading thereof through traditional brokerage channels. Crypto in the investment industry. The niche ragamuffins that are cryptocurrencies have recently started to be dressed and groomed by the investment industry in traditional ways to make them somewhat more presentable for investors, as well as easier to regulate. Various different types of investment funds, products, and derivatives have been established. The majority of crypto funds are either venture funds or hedge funds. These are exclusive funds made only available to institutional investors and high net worth individuals. Venture funds invest in crypto startups, making for a high risk and high reward profile. Crypto hedge funds are on a similar end of the risk spectrum. They combine crypto assets with other assets and financial instruments to make large short-term profits for their investors. Their investment horizons are shorter than those of venture funds. Crypto mutual funds are more vanilla than gnarly. They are available to retail investors with a low capital requirement compared to crypto venture funds and crypto hedge funds. They are less risky with more regulatory scrutiny. It is because of the high level of regulatory scrutiny on mutual funds that only one crypto mutual fund currently exists in the United States, the Bitcoin Strategy Pro Fund that invests in Bitcoin future contracts. The Securities Exchange Commission has been strict on establishing mutual funds with any other type of crypto due to their risky and speculative nature, which misalign with mutual fund requirements. Structured financial products known as exchange-traded funds, ETFs, are considered alternatives for investors that are looking to invest in something similar to mutual funds. ETFs are a collection of assets bundled into a product that trades on an exchange, usually tracking an index to gain exposure to an underlying theme across a diverse set of assets to spread risk and remain relatively diversified. Currently, due to falling into the same regulatory bucket as mutual funds, there are very few crypto ETFs in the USA crypto bundle, a product that sits between those that have been mentioned so far on the risk spectrum. Trading under the identity of a bundle loosens the regulatory threshold the product must meet to trade. This bundle loophole has also been made easier by existing in South Africa, a country with no regulation on cryptocurrencies as of yet. The bundle is known as the Easy Crypto 10 that tracks the top 10 cryptocurrencies ranked by market cap. In December 2017, the Chicago Mercantile Exchange launched Bitcoin futures contracts on their exchange for trading. Bitcoin futures are a derivative contracts that allows two parties to enter a contract to buy and sell Bitcoin as a predetermined price in the future. It provides natural leverage with only a small amount deposited, known as the margin, to open a contract. The investor has full exposure to the asset for only a portion of the value. These contracts can be closed prematurely by entering into an offsetting contract, usually done to lock in profits. Conclusion: investment characteristics. Bitcoin's investment characteristics is one of the areas that makes it such a fascinating asset. People speak of Bitcoin's store of value potential, while its price can be found all over the chart. indicating speculation more than anything else. For some, Bitcoin's potential of becoming the world's currency is still intact. Its correlation with other assets offers little information on it as an asset. It has seen its correlation converge and diverge with the Nasdaq Composite Index, a stock market benchmark, and it hasn't been found to move much with gold at all. Long-term gold correlation is roughly zero and had reached negative 0.4 in April 2022. In the last 3 years, Bitcoin's correlation with the Nasdaq has oscillated between negative 0.5 and 0.82. This 0.82 is its most recent correlation as a result of the Fed having started with a rate hike cycle in which most assets were stripped from their own devices and risky assets bearing the brunt of it. For now, it is best not to think of Bitcoin as a store of value. For clarification on this, the author refers the reader to Chapter 2 on price discovery. In times when the world is not dominated by powerful macro forces, Bitcoin's correlation with most assets will still be meaningless, owing to its idiosyncrasy and still relative juvenility. With that being said, on a relative performance basis, Bitcoin has by far outperformed every other asset class over the last 5 years, with a 48.71% annualized return, even after having dropped by roughly 60% since the start of 2022. In the 5-year time period, the Nasdaq Composite generated a 25% annualized return. The U.S. real estate market generated a 7.76% annualized return. The U.S. investment-grade corporate bond market generated a 0.86% annualized return, and gold, which is not an asset class, but considered better for comparison, a 7.21% annualized return. It is important to understand that reward is equivalent to risk. If the global economy, and more importantly the U.S. economy, had suffered in the last 5 years, the returns would have looked very different. Risky assets like Bitcoin and stocks, as opposed to bonds, outperform in the good times and underperform in the bad times. Therefore, return must always be considered alongside risk. We can measure Bitcoin's performance for the amount of risk taken by taking volatility as the denominator and return as the numerator. For Bitcoin, this ratio is 0.5. For the Nasdaq, it is 1. For gold, it is 0.41. For real estate, 0.43. And for U.S. investment-grade corporate bonds, 0.54. These numbers paint a very different picture from simply looking at the returns only. As far as return for risk taken goes, the stock market outperformed all the other asset classes in the last 5 years, with investment-grade corporate bonds in second place and Bitcoin a close third. Bitcoin trajectory. It is very tempting to yell up, up, up when asked, where do you think Bitcoin is headed in the long term? However, never has something been so simple in a market where free lunches are very hard to impossible to come by. Predicting how Bitcoin's price will move up to $2140 based on something as simplistic as following the halving cycle seems deceptively juvenile, especially as more sophisticated investors move into the space, all of whom are forward-looking sociopaths when it comes to today's news. The halving cycle is an event set in stone, impossible to be misinterpreted. It is, so to say, yesterday's news. Therefore, it can be categorized as something that has already happened, a past event in investment terms. What must be focused on are the salient factors that are less certain, factors that are open for interpretation and debate. These are the features that make a market. Regulation is one of the biggest salient factors. In many parts of the world, Bitcoin has become too big to stop. In the U.S., roughly 22% of the adult population own Bitcoin. To illegalize it would be political suicide. The only option left is to regulate it. This is already slowly happening. The same is happening in Europe. Regulation will provide a framework for industrial investors and other industries to adopt Bitcoin through which a new wave of interest will break. This will be extremely positive for Bitcoin demand. Institutional adoption of Bitcoin should further calm Bitcoin's erratic behavior, which, in turn, will open the cryptocurrency to further investment mandates. As it spreads through the investment space, it will find its way into more products and indicates then being eligible for larger index funds and more easily accessible through certain products that suit unique preferences and needs. Volatility dissipation will slowly weed out traders that seek volatility and cause volatility. Less speculative prices will push short sellers out of the space, resulting in a further dissipation of volatility. Education on the cryptocurrency is also inevitable as interest grows. A better understanding of it will open up more people to it. Thanks to education and better understanding, Bitcoin's daily news provocation will lose its potency. With extreme volatility gone, a Bitcoin bane to so many, more people will start to consider it. There is also the matter of the world set for a high inflationary environment in the upcoming decades, predicted to be driven by the deficits of the many metals that are key in the clean energy transition. Another salient inflation driver is the labor shortage being experienced all across the world, which automation is not set to keep up with. People will be looking for a store of value, and Bitcoin will be an eligible candidate, if not the best candidate. The recent pickup in de-dollarization because of America's abusing it as a sanctions weapon means many countries will be looking for a substitute reserve asset to store their national earnings in. With less volatility, Bitcoin should be one of the top candidates. Personally, I believe it is likely that Bitcoin will continue its upward trajectory in the many decades to come, supported by the various drivers mentioned, with a lower standard deviation and lower return on investment, ROI, than in the past. The lower ROI is the natural effect of an asset maturing and not growing at the same rate it is used to. The cryptocurrency is likely to outlive most companies in existence today, owing to its incorruptible nature and timeless store of value characteristic. Bitcoin has the potential to outpace inflation with a healthy margin over the next couple of decades, and may very well become the preeminent store of value. Store of value is one of Bitcoin's two main promises. This is an important characteristic for every Bitcoin user, and especially for users residing in high inflationary countries. The other promise is financial inclusion and freedom. This is more relevant to the part of the global population that lives in developing and frontier markets, where mostly authoritarian regimes are in place and the banking system is underdeveloped. Both of these two salient qualities will remain with Bitcoin for as long as they are necessary. Quantitative findings, Bitcoin wallets increasing yet transaction volume remaining the same, and qualitative findings. The growth of peer-to-peer Bitcoin use in Africa seem to suggest Bitcoin is already moving in those directions. Last words. Having lifted the hood on Bitcoin, it has been shown to be an extraterrestrial engine of an autonomous vehicle that can truly take one to miraculous places. It has made its rounds around the world as a derrico on a clockwise route, while the Earth rotates counterclockwise around its axis. It has, at times, led to the nonsensical, the first president to adopt it being a dictator. It has grown at a speed rarely seen in a lifetime. It has shown a charisma that had some of the world's most rational people throw their everything into it. It has brought digital energy into cyberspace for the first time, and it has shown a fluidity that has only been matched by the elements. Liberator of the oppressed, digitized enigma, custodian of energy, friend of criminals, airbender, Bitcoin.